massive heart attack. And we were facing a complete collapse of our financial system and the potential for a repeat of the Great Depression. In the Great Depression, it sounds like ancient history, people had 25% unemployment. I mean, there was massive economic hardship across the country. And that's when we went to Congress and said, we need Congress's help to stabilize the financial system. And Republicans and Democrats came together and cast votes that were very controversial at the time, and they got the authority, gave us the authority to bail out the financial system. Now, we hated that we had to do it because we were a free market administration. If you take a risk, you should bear the consequences of that risk. But when the financial system collapsing would have led to a devastation of Main Street, that's when we knew we had to set our free market ideology aside and use taxpayer money to stabilize the financial system. So in my view, it was the right thing to do, and we stabilized the heart attack. We did not face a Great Depression. But 10 years later, the recovery is still long and hard. And while Wall Street has fully recovered, with firms having record profits, share prices reaching new highs, Main Street has not still fully recovered. And so a big dialogue that we have at the Federal Reserve constantly when we're trying to assess monetary policy is, how's the job market doing? Have we reached full employment? Does everybody who wants to get a job, are they able to get jobs? By some measures, if you look at the headline unemployment rate, which gets a lot of attention, 4.1%, by that measure, we're all back. But if you dig beneath the surface, by some measures, there's more than 1 million Americans who are still out of work today who should be back in the job market if the economy was the way it was back in 2006. And so Wall Street has recovered, the banks have recovered, Main Street has not yet fully recovered, and I think we need to remember that. Now, if you look back, further back in time at world history is full of financial crises. These happen pretty frequently and quite predictably. And it's, if you just look at American history, you've got a bunch of banking crises in the late 1800s. That actually led to the creation of the Federal Reserve System, a banking panic of 1907. You had the boom in the 1920s and then the Great Depression resulting from that boom. You had the Asian financial crisis in the 90s, and then you had the tech bubble bursting, and then you had the Great Recession in 2008, 2009. So we know how damaging these can be, yet they keep happening. And the question is, why do they keep happening? They keep happening because we forget how bad they were. We forget the lessons of prior mistakes, and then we go on and repeat them. Now, typically, it's not the same people making the same mistake. Oftentimes, it's the next generation who forgets the lessons that their parents or their grandparents learned. So if you look, there's economic research looking at people who lived through the Great Depression, how that experience changed their behavior for the rest of their lives. And it was the next generation or the generation after that that put the Great Depression behind them. One of the concerns I have right now is that we are forgetting the lessons of the 2008 crisis right now. The same generation that were involved in creating the crisis are now forgetting those lessons. So we don't have to wait for our children or our grandchildren to forget. We're forgetting right now. And why are we forgetting right now? In some sense, it's because the bailouts worked too well. I mean, they did their job. They stopped the heart attack from killing the patient. But now that Wall Street is fully recovered, and shareholders are fully recovered, and the management teams have recovered, and the boards of directors have recovered, from their perspective, what crisis? It wasn't so bad. We're back to the good old days. And so that's a real challenge for all of us. Now, that challenge is really what motivated us at the Minneapolis Fed to spend the last 2 years looking at what can we do about this? Is there a way to institutionalize the lessons of this crisis so that 20 years from now or 30 years from now or 50 years from now, that generation does not repeat the same mistakes again? And I want to give a shout out to my colleague Ron Feldman, who's going to be speaking in a few minutes. A lot of people have written books after the crisis saying they saw it coming. Well, Ron Feldman, who's our chief operating officer at the Minneapolis Fed, and one of my predecessors, Gary Stern, wrote the original book, Too Big to Fail, in 2004, in advance of the crisis, saying these big banks are too big to fail and they pose a risk to the economy, and they were right. So in 2016, when I joined the Minneapolis Fed with Ron's help, we said, let's look at everything. Let's have a blank sheet of paper and let's see what can be done to try to solve the problem of too big to fail banks and these financial crises. And we brought in experts from around the world to share their best ideas. We released a draft report a year later. We released the final report of December of this past year. And we think that our plan can substantially reduce the risk of too big to fail banks and the risk of financial crises while allowing the market to make decisions on where people invest. So allow the market to use its best features, but at the same time create guardrails so that they cannot drive the financial system over a cliff. So we learned a bunch of things through this process. Number one is you can never eliminate all risk. I'll give you an example. Think about the risk of terrorism. You know intuitively we can never take the risk of terrorism down to zero. There's always going to be some risk. And you know intuitively more safety comes with more cost, right? We pay for law enforcement, we pay for metal detectors. Safety isn't free. So we as a society have to decide how much safety we want and what price we're willing to pay for that safety. You know, we could all drive 20 miles an hour on the highway and probably eliminate motor vehicle deaths, but there's a cost associated with having to drive so slowly. Well, the same thing is true in financial stability. How much safety do we want and what price are we willing to pay? And that's cost and benefits is key to the analysis. And then another key learning was that only equity, instead of debt, only equity really takes losses in a crisis. And so that together, Ron will go through more of the details, that together led us to propose substantially increasing the equity requirement of banks, of large banks. So let me explain what that means. When my wife and I, we bought a house when we moved to Minneapolis. The bank that we got a loan from made us put 20% down on our house. The reason we had to put 20% down, that 20% is designed to protect the bank in case we run into financial trouble. Because if I ran into trouble, the bank would repossess the house, they'd sell it, and then that 20% gives them a buffer to get their loan paid back. Well, big banks today have about half that amount down on their own investments. And so if we doubled the amount of equity, skin in the game that big banks have on their own investments, we could go a long way towards solving the problem of too big to fail and protecting taxpayers. It's really not more complicated than that. Second, we look at hedge funds and the shadow banking world and make sure that they're not over leveraging themselves, taking on too much debt. So we level the playing field between big banks and those big hedge funds. And then lastly, we reduce some of the regulations on community banks that are not systemically risky for the country. Those are the high-level elements of the plan. Now, one key to this is you can actually calculate the odds of a financial crisis based on how well capitalized the banks are. You know, back in 2006, if we'd done the analysis then, there was a 90% plus chance that we'd have a crisis sometimes in the next century, just because our banks were so undercapitalized. Today, the banks have some more capital than they had back then, but there's still about a 70% chance of another crisis in the next century. We can reduce that with our plan down to around a 10% chance. So you can substantially reduce it. You can't make it zero, but you can substantially reduce the risk while also having more benefits for society than those costs. So we think our plan strikes the right balance. Now, last thing I'm going to say, and then I look forward to our conversation. We know the regulatory winds are blowing against us right now, right? The winds are in terms of deregulation. Congress is considering a bill to relax regulations on very large regional banks and on small banks. And the tough part is, as I said earlier, the shareholders got bailed out. The boards of directors got bailed out. The management teams got bailed out. So from their perspective, there was no crisis. So why would they do anything? And so I was chatting with Bill earlier that I was trying to think of who has the long-term perspective to keep this agenda alive and to drive change. And one idea that we were thinking about was it may well be that labor has the role to play, because it's labor that is still suffering from the crisis. And through labor's pension plans, for example, there are examples where labor is driving change in corporate America by demanding corporate governance changes, by demanding socially responsible investing. I would ask labor to consider, and Bill's representing here AFL-CIO and among others, I would ask, what about labor taking on too big to fail? And saying, you know what, it's okay that Wall Street got bailed out, but our own members are still suffering. Maybe we can play a role here in helping to keep this agenda alive so that we don't forget. In any case, those are my brief overview remarks of the too big to fail issue. I want to thank Bill and Howard University again for sponsoring this important event, and I look forward to having our discussion. Thank you very much.
All right, first I just want to say thank you for joining me.
Thank you.
Here at Howard. back there. All right, I'll move this. Right, man of impressive accomplishments, deep resume. So my first question to you is, how do you rock a bald haircut that looks so good? No, I'm kidding. Okay, I'm just joking. Let's jump into it. The bill you referred to, I believe, is H.R. 4061 that's going through Congress right now, looking to protect banks and apply more regulations if they are too big to fail. Tell me why that's so attractive to politicians right now, the 4061.
Well, and I don't remember the bill number, so I'm sure you're right. When we travel around, my region that I cover for the Federal Reserve is Minnesota, North and South Dakota, Montana, part of Michigan, and part of Wisconsin. Much of it is rural. And when you go out to rural communities, they say, hey, these big banks don't know what's going on in our community. The big banks are not comfortable making loans in our community. We need our community banks because they know the local market. And so I think the overall arching spirit of what Congress is trying to do is to relax some of the regulations on the community banks because they're not risky. They're not going to bring down the U.S. economy. But it doesn't just do that for community banks. It also does a lot for regionals and very, very large regional banks, which were actually quite systemically important back in 2008. So if we're up to me, and our plan is to really focus on community banks for the relief and then be much tougher on the biggest banks, I think the regionals are doing just fine.
So you believe that tougher regulations on the bigger banks would probably ameliorate any future issues should they arise, rather than focusing on the smaller banks that most people have access to?
Right. It's really the systemic risk really comes from the giant banks that are, there's about a dozen or so of them in America. Those are the ones that in 2008 almost brought down the U.S. economy.
Okay. And you also talked about doubling the equity of banks. Why has this theory or ideology or belief put you at odds with some people in the banking industry when it comes to that proposal?
It's going to hurt their stock prices. Full stop. I mean, the more leverage a bank can take, the higher their earnings per share is going to be, and the higher their stock price is going to be. So if we make banks put more skin in the game, you would expect, all else being equal, their stock prices are going to be lower, and they're not happy about that. And so I understand their incentives. Their incentives are the taxpayer, the public, should take as much risk as possible, and then they capture the upside. By making them put their own skin in the game, they can get the upside and the downside.
Now, have we seen any examples of this? How do you think that this would play out? If you were to use another country or another bank, for example, where are we seeing indications that this would be a resolution to this?
Well, if you look at every other industry in America outside of banking, big companies can take on debt, but no other industry is levered the way the financial sector is levered. No industrial company is levered. Even with the 20% equity that I'm talking about, or 25%, no industrial company has that much leverage, 75% leverage. And so there's something, the banking industry has somehow convinced us that they need to be much, much, much more leveraged than Boeing, or than General Electric, or than General Motors. And I haven't seen any compelling reason why that's true.
Okay. In March, looking at the unemployment rate, it remained largely unchanged from the previous month. What indications are we getting from this maybe ephemeral stagnation? Maybe it could be longer. What do you make of it?
Well, this is the big conundrum that we've been wrestling with at the Federal Reserve, which is one of our mandates that Congress has given us is stable prices. So an economy that's not overheating but not limping along. The other part of the mandate is maximum employment. That means as many Americans who want to work are able to find jobs. So we're always trying to assess, are there people who are unemployed who would like to work? That headline unemployment rate that you mentioned is 4.1%. Historically, that was a pretty good proxy for how strong the labor market is. But the 2008 crisis was so brutal, it drove a lot of people out of the job market altogether. So they're not even counted in that statistic. So we have to look at other measures to try to get a sense of, are we back at maximum or full employment? And again, I mentioned earlier, I think there may be, by certain measures, there's something called prime age labor force participation or prime age employment to population ratio. There may be a million or more Americans who are still on the sidelines who probably want to work, especially if wages start to pick up.
Right. Again, this ties into inflation rates as well. And there has been a belief that the current Fed Reserve Chair, Mr. Powell, is very hawkish when it comes to inflation rates. Where do you stand on your beliefs on where inflation rates should be right now?
Well, we have a goal that we've set of 2% inflation, and we call it a symmetric target. That means sometimes we might be a little bit below 2%, sometimes we might be a little bit above 2%, but we want to average 2% over the longer term. I'm the person who voted against all 3 interest rate increases last year, and the reason that I did that was because we keep coming up short on our inflation target. We've been undershooting it for 4 or 5 years in a row. There now are indications that inflation is gradually starting to move towards our 2% target, which I think is a good thing. It's good for us to hit the goals that we set. But I don't see any signs of any sudden acceleration in inflation or of overheating. And so I'm open-minded and I'm paying attention to the data. The data, at least now, is moving in the right direction.
Okay. If you were to give an estimate when you think Fed should raise rates again, is that hard to say right now?
It is. I prefer not to make such predictions because I want the data to guide us rather than some promise that we've made. So I don't know, but I'm looking for signs that we're using up the slack in the labor market and that we are, in fact, hitting our inflation target. Now, one thing back to the labor market, your basic economics, you want to assess supply and demand in a market. Start by looking at the price. And the price of labor is wages. And wage growth, wages are growing, but they're growing slowly. We would have expected that wages would be growing more quickly at this part of the economic expansion. The fact that wage growth is modest suggests to me there's probably still some slack in the labor market that we're not yet at maximum employment.
And that could be part of the reason why there's been such a push to raise the minimum wage in particular jobs. You hear a lot of people advocating for this. How do you think raising the minimum wage for more jobs across the country would affect the economy as a whole?
It's a very important research question. And actually, so we're based in Minneapolis. Our city voted to raise the minimum wage to $15 an hour over several years, and they put out a request for researchers to study the effects of this. Because on one hand, you think, well, somebody whose minimum wage goes up, it's clearly benefit for them, right? Others have said, but if it leads to fewer hours, then it may not be as clear-cut a benefit. And so what we're doing at the Minneapolis Fed is we are embarking on an 8-year study to very dispassionately just analyze what does this affect on the economy? What does it mean for workers? What does it mean for firms? What does it mean for the region? And so I don't want to prejudge, but we're going to take a very serious look at it.
One of the big topics of conversation over the past few years has been the Glass-Steagall Act. And if you could explain that to people, the basics of it, and if you think it should be a stronger part of our regulations today.
So what Glass-Steagall did was, after the Great Depression, it separated commercial banking. So a bank makes a loan to you to buy a house or to buy a car or to a business to fund expansion. That's commercial banking, lending, from investment banking, where you're trading stocks and bonds. It's considered riskier activity. So after the Great Depression, they decided to separate those two activities because the commercial bank that makes loans to you also takes your deposits. And so Congress said, well, we want to separate taking deposits from some of this riskier activity. Then in the late 90s, that was repealed, and they were allowed to merge again, those two activities. So some have said that that was a source of some of the risk that led to the crisis in 2008. I'm not opposed to reinstating Glass-Steagall, separating these things again, but I don't think that by itself would address the too big to fail issue, because there were banks that were pure play investment banks, and there were banks that were pure play commercial banks that got into big trouble in 2008. It was not simply the combination of those two activities that made them risky. It was their scale. And so, again, I don't think it's a bad idea, but I don't think it by itself would address the too big to fail issue.
Okay. How could it be supplemented to address that issue then? Since that was part of the fundamentals of trying to break up banks so that they weren't too big, and of course that was concomitant with the Volcker rule. What supplementation would an act like Glass-Steagall what could be implemented so that it would be widely sustainable?
I think the most powerful thing we can do, which is the core of our plan, is to force banks to put more skin in the game. And here's the thing. Banks love to say that they have great economies of scale, meaning all of us as consumers benefit by these banks being gigantic. But then they say, but we can't afford more capital. Well, you can't have it both ways. If there actually are economies of scale, the banks should be able to afford to have more skin in the game. So my view is, if we force the biggest banks to have a lot more equity, skin in the game, they would then be forced to decide, does our business model really work? Are there real economies of scale? And what I think would happen is banks would choose to restructure themselves. So there might be certain business lines that really do make sense to have at big scale, and then they'd be well capitalized. Other business lines where there were not these economies of scale, they would probably choose to break themselves up so they could achieve a lower level of capitalization. That to me is a way of achieving the same goal, but allowing the banks to figure out what makes economic sense. We set the rules and then let them adjust their own businesses to meet those rules.
Has there been anyone who's been receptive to this so far?
It
seems like a hard
Bill,
sell for something. Yeah.
I meet with many members of Congress and senators on both sides of the aisle. And most people that I meet with agree with two things, Republican and Democrat. The biggest banks in America are still too big to fail. And community banks need some relief. So I actually think that there is a compromise to be had where you address both of those at the same time. But again, I'm also recognizing the broader political wind way they're blowing right now. And my big fear is that we're missing our moment. That if we don't act soon, we will all forget how painful this crisis was. And then it'll be the next generation or the generation after that that has to put the pieces back together again.
When you're looking at some of the regional banks and community banks, that also includes the nation's few black banks, right? Where do we stand in trying to bolster banking coming from the black community and either sustaining the banks that we have, the few that we do have, or growing what we have so far?
Well, the black-owned banks that you speak of, generally speaking, are community-related banks or small banks that I think would benefit from some of our proposals to relax regulations on the small banks. So I think that would help. But it's a big issue. I mean, in North Minneapolis, which is part of our district, right in our backyard, it's access to credit is a huge challenge. And I know there have been many initiatives to create local credit unions or local CDFIs to support the local community. Some have had some success, some have struggled. I know there are new efforts underway to try to restart those efforts. So we're supporting however we can, but I acknowledge it's a big challenge.
Okay. Where does Dodd-Frank fit into that?
Well, I think Dodd-Frank did some good. I mean, Dodd-Frank has introduced stress testing to test the banks to see if they're safe and sound. In some cases, they've given regulators new tools. So I think Dodd-Frank did some good. We shouldn't get rid of the whole thing, but it didn't go far enough. It is not addressed too big to fail. The biggest banks in America are still too big to fail. And if we want to do something about it, we need to go further than Dodd-Frank.
Okay, all right. And how have you been appealing to legislators, lawmakers, to really drive the point home? Obviously, it's going to be repetitive. It's going to take lots of charts and models. Where are you seeing your communications are most effective in trying to relay to them that there needs to be a reform in regulations when it comes to small and regional banks?
Well, we at the Federal Reserve, we've got lots of rules. And one of our rules is we're not allowed to lobby. So we don't go lobbying, we don't go advocating for this legislation or that legislation, but we do want to inform policymakers and inform legislators, give them the best analysis available so that they can make the best decisions possible and make ourselves available to their staff. So we're doing that as much as we possibly can. But at the end of the day, it's up to the public to decide, is this something that they want to take on? It's up to the public to decide, is this an issue that's important to the public?
Another huge issue, important to the public, wealth disparity continues to grow in this country. What do you attribute that problem to, and how can that be ameliorated? To your best estimation, there are a lot of...
Yeah, it's a huge, complicated problem, and in a sense, it's the accumulation of multi-generational opportunity gaps that just gets passed on and ever bigger and ever larger and ever larger. And so, number one, trying to create equal opportunity for everyone is at least a start. It's not by itself going to close wealth gaps, but at least it could stop the problem from getting worse and continuing to expand. So that's where I would focus on starting. And this is really the purpose of our new research institute. I'll give you an example, which you all probably know, but it was a surprise to me when I learned it, that in America, in the U.S. economy, African-American unemployment is always twice white unemployment. Yeah. Even if you adjust college graduate against college graduate, it's always 2 to 1. If it's a recession, it's 2 to 1. If it's a booming economy, it's 2 to 1. Or high school dropout against high school dropout. And so I started asking basic questions for why that is there, why is it so structural? And I didn't find very good understanding across the Federal Reserve system. And so we said we need to learn a lot more, and let's have a focused research effort. We hire more PhD economists than anybody in the world. If we can get our own researchers focused on trying to understand these issues with the guidance of people like Bill, our advisor, or one of our advisors, we feel like we have a contribution to make. So I wish I had the answer. I wish I had a definitive answer. It's an important question, And we want, with Bill's help and others, to get to the answer.
All right, I'm going to ask you another question. I don't know if you have a definitive answer
Okay.
on this, but Dr. Spriggs talked about slaves never being compensated for the work that they've done, and you talked about multi-generational gaps. We know that there have been lots of multi-generational issues that have led to wealth disparities. In your estimation, the hot-button topic of reparations, what would that look like to you?
Well, it's a very complicated issue, and I have to say
Yeah.
I have not studied it closely enough. You know, I read a lot of American history, and the more American history I read, the more examples I come across where the preferred groups were given preferential treatment. And, you know, I learned, we had at our institute, Richard Rothstein came and spoke about HUD policies, which were giving advantage loans and housing whites only. And I don't know, I mean, it's a question for Bill and for others. Has anybody quantified all of these benefits that have been given along the way and tried to add it up, and what does it mean in real value today? Maybe that's already been done, but I'm learning, and I've got more to learn on the topic.
Okay, so you're saying paternal capitalism is another research topic that people can study. So all you scholars out there who are looking for research topics, paternal capitalism might be one of them. Moving on to inflation rates, looking at global inflation rates, what do you think is causing these to fluctuate and causing these lower rates?
You know, it's a good question. We think, if you look at what does the Federal Reserve control? We control interest rates, short-term interest rates, moving them up and down to try to manage economic cycles. Long-term interest rates and long-term inflation are really being driven by broader macroeconomic forces. So one thing that we have in common with Europe and the UK and Canada and Japan, all of our societies are aging. So we think that the aging of societies is probably contributing to this low inflation that we've been seeing around the world. And all of the societies are continuing to age. They're just getting older and fertility rates are going down. We're having fewer kids. So we think that that's a big driver. And then also productivity is tends to be a global phenomenon. So if one of the students in this room creates some great new app for, let's say, your iPhone, and it's a killer app and everybody loves it, well, guess what? People around the world will download it and use it. So when we develop some new technology, it tends to be adopted globally. Technology development also, we think, is playing a role in these low inflation rates, and whether or not productivity is low. So these things are related, and it's hard for us to know exactly what's driving what.
Okay. And again, technology affecting inflation rates, but also jobs and job growth as well. One of the topics that people have talked about recently is universal basic income. Where does that come into play when you're looking at the economy?
It's an interesting concept. There are doomsday naysayers who are saying that automation is going to put all of us out of jobs. That there's huge swaths, millions of Americans are going to be out of work because they used to have a job and now a robot does the job, or artificial intelligence.
You buy that?
I don't buy it.
Okay.
Because people have been predicting this for all of human history, and yet the jobs change. So when people brought automation to farms, they said, oh my gosh, it's the end of labor. Well, then they moved to factories. And so I think the nature of our jobs are going to change. And I admit it'll probably be disruptive. You know, if you're a truck driver and now a self-driving truck comes along, that's going to be very disruptive to you personally. But I'm not a buyer. I don't believe that there's the end of labor. I think the jobs are going to change and we're going to have to transition.
Okay. And how do you promote that message that jobs need to change, or the vocations or the education needs to be?
Well, it all is about education. It's about finding a way to give access to high quality education to more and more and more of our young people. We know this has been going on for a long time, and it's only accelerating. And so the need to find a way to scalably educate people, and it can't just be take on more and more and more and more debt. That's not a solution for the country. We need to find more scalable ways of giving kids a high quality education. And so I wish we could solve it at the Federal Reserve. It's an important topic, but we're going to need Congress involved and educators, clearly.
Okay. The last question on redistribution of wealth. When you're looking at the TARP program, a lot of people argued that putting money back into banks, essentially what some call corporate welfare, would have been more detrimental than if you had reversed that and put money back into the public.
You know,
Take us through just your thought process
Sure.
on that and why you feel you made the right decision.
Let me go back to my analogy that the U.S. economy had a massive heart attack. And when you're, heaven forbid, you have a massive heart attack, You go to the ER, your doctor is going to do whatever he or she can to stabilize your heart. And that's what we were doing because that was the most direct intervention into the U.S. economy possible. We ended up investing in 700 banks. And by the way, the capital program basically got all the money back for the taxpayer. So we designed it to actually get the money back if the banks recovered. If instead of doing that, we said we're going to go to 100 million individuals, there was no way for us operationally to do that in a short period of time. But investing in 700 banks, we did that in a few months. And so it was like a shot of adrenaline into the heart. That was the only way we knew how to try to save the patient, recognizing that the recovery has been long and hard.
All right. Okay, thank you very much.
Thank you very much. I appreciate you having me.
Yeah.
Thank you. Sure.
Yeah, we'd like to take some questions from the audience. Who would like to ask Mr. Kashkari a question? Don't be shy. Yes.
Hi, Mr. Kashkari, Jennifer Shaw, Fox Business. It's great to meet you. You're concerned that we have this all too big to fail, and you'd like to double the capital requirements to elicit the nation's largest banks to break up. Yet the Fed is proposing simplifying and retooling of current capital requirements, and in one case, in fact, easing. I'm talking about the index of funds to leverage ratio. How can you support this?
Well, those are policies that are set by the Board of Governors, not set by the regional banks. So in a sense, I don't have a vote, to be specific. And if it were up to me, we'd be increasing the leverage ratio requirements, not decreasing the leverage ratio requirements.
But don't you have any influence on the discussion there at all?
I think I've been very outspoken on my view of bank capital, and I think everybody across the Federal Reserve knows my views on bank capital. And so, trust me, I'm not shy, and I'm advocating to everybody who will listen that we should be increasing capital requirements. Hi.
Omar, just a general question about being too big to fail. In a lot of industries, it's more common now to have consolidation of power amongst companies where you have major players in the company. What's to prevent other industries from running into the same type of power? Would that be an issue that the Reserve Bank would try to address?
I don't see it because the market is providing is being strict on other types of firms and how much debt they're allowed to take on. That's one of the things we learned is that debt is the source of the instability, because if you borrow money and now all of a sudden you have an economic downturn, you still got to make those payments. And that's really was the source of the risk in the banking sector in 2008. But if you look at industrial companies, if you look at virtually any other kind of company, the banks and the market do not allow them to take on the kind of debt that big banks take on. And so for some reason, the market mechanism has broken down that's allowing banks this unique position to just lever up and introduce a lot of risk.
Just to follow up on that, this is something on your side. So when you think of the major employers in the U.S., in almost every state, major employers, Walmart, and you have UPS, and when UPS had the problems a while ago, it wouldn't be as bad as it would be now because those companies are even larger. Like the American economy basically depends on a couple of large employers. And that's still along the same line as too big to fail. The government used to kind of prevent companies from getting so large, but it doesn't really anymore. So what role do you think the government should play in controlling the size that companies get in general?
Well, I think this is the domain of this antitrust policy and whether or not things like AT&T were broken up, et cetera. I believe those decisions are being done and based on competitive reasons rather than risk to the U.S. economy. I don't know of many examples where, I guess we have bailed out. The U.S. government in history has bailed out. They bailed out Chrysler, they bailed out General Motors, et cetera. So I think it's a complicated question, and I don't have a short answer for you, but I'd be happy to chat about it offline. Thanks.
Hi, my name is Colin. I'm a freshman student here. And as I understand it, one of the biggest problems with the financial crisis was you had a lot of individuals, both consumers and bankers, who essentially had no idea what they were investing in. So you would have someone who bought a bunch of mortgages, and then those would get packaged into a collateralized CDO, whatever. And basically, I'm wondering, is there any regulation that has already been passed or anything that is being proposed that helps people to actually understand all the networks and connections in the financial sector that are contained in their specific investments?
It's very hard because markets continue to invent new types of products. And I'll give you an example. So there's something in the last few months, volatility for the last several years in the stock market had been historically low, very low. And then all of a sudden volatility spiked up when some uncertainty was introduced. And then there were these funds that blew up that were betting on low volatility continuing for the foreseeable future. That came as a surprise to a lot of folks. You know, people thought they knew what they were buying. The funds blew up. They didn't assess the risk properly. So the challenge is that whatever specific little rule we might create, it's likely in 5 or 10 years the markets will have found ways around it or invented some new product that we hadn't thought of. That's why equity is so powerful. Equity, simply put, is skin in the game regardless of what you invest in. So whether you choose to invest in Bitcoin or mortgage-backed securities or these volatility products, if you have more skin in the game, you're the one who bears the losses, regardless of what new instrument gets invented. And that's why I, for one, think equity is the most powerful tool we have, because it's simply you putting your own money in the game.
Well, could you provide a specific example of how a bank who has a lot of equity, how certain actions that they would take that led to the financial crisis would have affected them at that point?
Sure. Well, first of all, they would have, if they had more equity, they would have been buying less subprime debt. They would have been, it would have just de-risked the institution overall. And so I think the housing bubble would have been less of a bubble if the biggest banks had more skin in the game to start with. And then second, even if they had the same exposure to things like subprime, when the value of those bonds fell, they would have enough of their own money in the game to cover their losses rather than going potentially facing bankruptcy and instead having to turn to the taxpayers.
Okay,
thank you.
Really quickly, should there be more regulations on subprime lending?
Well, I think there's a lot. I mean, I think this is one of the changes that's happened. If you look at the data on who's getting mortgages today, generally speaking, it's people with very, very good credit are getting mortgages today. So I think the question is, has the pendulum swung too far? I don't know the answer to that, but right now I was surprised when I looked at the average FICO scores of people getting mortgages today. It is very, very high.
Good afternoon.
Hi.
My name is William Austin. I'm actually a grad student at the University of Maryland, but I live only half a mile from here, so it's second stop making open to the public. My question is, earlier you mentioned that reducing possibility of economic downturn from 70% to 10%. What I'd like to know is how you're getting to that, and are you factoring in the high degree of kurtosis that was not factored in during the last crisis, perhaps why banks were so forward of this?
Well, we looked at, the IMF has a database that we base our work on of the history of financial crises around the world. And you know, even though hurricanes are infrequent events, you can actually predict the probability of a hurricane just based on prior hurricanes. Same thing with financial crises. So in the IMF database, you can look at how frequently do crises happen and how well capitalized were their banks when that crisis took place. So based on that data, there's a very clean curve that you can draw that says with higher capital, the probability of a future crisis goes down. And then there's very detailed work done on our website, minneapolisfed.org, where you can run through all the calculations of how we get to that, from the 70% down to the 10%.
I may ask one follow-up question. You mentioned earlier that the breakdown of the relationship between unemployment earlier. Do you think that a better ratio to use now is the employment to population ratio?
I do. Employment to population, we also look at labor force participation. We look at a bunch of different measures, but right now I think EPOP is a very good one, especially employment to population ratio for prime age workers, because you know more and more young people are going to college, so they're not going to be counted in the labor force if you're 22 years old and you're in college. The prime age is from 25 to 55, so your data is not getting muddled up by people who are staying in college, nor is it by retirees. So 25 to 55, it's a nice way to look at the labor market.
Thank you.
Thank you.
My name is Rafael. I'm a freshman. I'm here in Howard.
Hello.
I was wondering about, you said that labor would be a good candidate for kind of shaping policy in terms of making sure price this doesn't happen again, because Main Street was definitely more affected by the too big to fail than the actual banks involved were. So in terms of that, what kind of institutions are going to be there speaking kind of will of labor, and what programs is the federal government taking on so that we'll be paying more attention to labor sources and shape policy?
Well, the latter is a good question, and that's a political question that's far outside of anything I can influence at the Federal Reserve, because we have a very narrow mandate relative to those questions. But I do think, you know, after I was in Treasury, I worked for a big investment company called PIMCO. And one of the things I observed was that the pension plans actually have influence and have demanded that There are transparency standards that are introduced from corporate America, that corporate governance reforms, making sure that boards of directors are diverse or that they're voting on executive compensation. Those are the types of tools that I think labor can use through their pension advisors to try to drive change in corporate America. But it's not going to be easy, I know that. Thank you.
Well, sorry, that's all the questions that we have time for. Sorry, Johnny. Thank you very much, Neil. Thank you very much, Colin, for the very insightful interview. It was fantastic.
Thank you.
Could our panelists please come up to the stage? Feedback. There we go. Can you hear me? Okay, thank you, panelists. So while everyone settles down. So what I'll go ahead and do is I'll give us a quick introduction to what we're discussing today. We already know we're here to discuss too big to fail, but I just want to give some of us some context for what's been going on. So on average, U.S. banks have grown increasingly larger over time, while the total number of banks has declined. Examining data from the FDIC, the average total assets adjusted for inflation of U.S. commercial banks rose from $160 million in 1984 to $1.35 trillion in 2017, while the number of banks fell by more than 66%. Moreover, the share of total banking system assets held by the very largest banks continued to rise. In 2011, according to David Wheelock, Vice President and Deputy Director of Research at the Federal Reserve Bank of St. Louis, the 5 largest banks held 48% of the total system's assets. So to understand this idea of what's been going on. Now we're here to discuss too big to fail, addressing risks in banking sector 10 years after the Great Recession. And we have superbly qualified panelists here that I'll quickly introduce, and we'll go ahead and get it started. So first and foremost, we have our Makeda Henry Nicky here. She's actually a Howard alumni. Right now, she's a David M. Rothstein Fellow. Sorry, I should have paused for class. In Governance Studies at the Brookings Institute. So we're very proud to have her here. And thank you for agreeing to come. Prior to joining the Brookings Institute, Makeda was a senior analyst with this Consumer Financial Protection Bureau, or as it's commonly referred to as the CFPB. Following that, we have Dr. Simon Johnson, who is a professor of entrepreneurship at MIT Sloan School of Management. He is also the head of Global Economics and Management Group and a senior fellow at the Peterson Institute for International Economics in Washington, D.C. He co-authored the book 13 Bankers, The Wall Street Takeover and the Next Financial Meltdown, a very successful book. It was an immediate bestseller and has become one of the most highly regarded books on the financial crisis. It also has very good reviews on Amazon as well. Last we have Ms. Heather Slavkin-Korzo. Not lastly, we have one more. She's the director of the Office of Investment at the AFL-CIO. Heather received her Juris Doctor from Boston University School of Law and a Bachelor of Science in Journalism from the University of Florida. Heather served as a lead policy advisor on the financial regulatory reform for the AFL-CIO throughout the 28 financial crisis and the Dodd-Frank legislative implementation process. So last but not least, certainly, we have Mr. Ron J. Fieldman, who's the first Vice President and Chief Operating Officer for the Federal Reserve Bank of Minneapolis. Thank you for coming. Mr. Feldman previously served as a Senior Officer for Supervision, Regulation, and Credit. He's a co-author of the book Too Big to Fail, The Hazards of Bank Bailouts, and his foreword was written by Paul A. Volcker. So thank you all for coming, and I'll go ahead and start with a lead-in question, and we'll give everyone a maximum of 5 minutes to discuss this particular question. So to start out, what do you think are the key takeaways from the Great Recession, and what financial risks do we still face? How do those risks affect workers, consumers, communities of color, and macroeconomic policy, in particular monetary policy? So we'll go ahead and start with Makeda first, and move on.
Well, first, thank you for having me. It feels good to be home. It's Dr. Sprice, Dr. Pagalo. So let me just kind of start back and take a step back and say, for me, the Great Recession and the financial risks that were unearthed, which I wrote about in my dissertation, I took two important things away from that. One, when we let our financial regulatory system persist with gaps, we put a considerable amount of stress on consumers and their financial resilience. So, and I understand that to be their capacity and their ability to respond to or recover from shocks. So think about, the Hurricane Katrina and what that looked like for New Orleans versus Hurricane Sandy, and how that, what that recovery looked like on the East Coast. And from there, I think in the post-crisis recovery period, what we saw was that it unearthed, and of course it exacerbated by the crisis, large structural wealth and income inequality. And as we sort of came out of the crisis, what we saw were African Americans and Hispanics emerging from that crisis in a very weak position. For African Americans, 75%, and for Hispanics, 50% of their collective net worth were eviscerated, right? And so to even take it a step further, as the economy recovered, and Neil, you spoke about this, we've got this very uneven recovery. Main Street, the banks, shareholders, and white households have recovered, but African Americans and Hispanics are in the weakest possible position in terms of what pathways or what access they have to rebuild that wealth. Their home ownership rates are at historic lows, 42%, 46%. And so for me, we're in a situation that we must contend with, where we've put millions of minority families on a clear trajectory towards a permanent underclass. And there's research out by the Prosperity Now and Institute for Policy Studies, that shows that 72%, by their calculations, 72% of Black and Hispanic households can be classified based on their assets as asset poor or working class. And so when I kind of say that we've put millions of families at risk and set them on a path to become a permanent underclass, this is a real problem for us as an economy to struggle with. Secondly, only 15% of Black and Latino households can be classified as middle class. And then you add to that, right, all of the stories around, the Dodd-Frank, the TARP, the Volcker Rule. What we really, when you step back, you think about how our regulatory system is just as responsible for putting disproportionately exposing communities of color to the kinds of predatory lending and business practices that eviscerated a generation of wealth. So when my parents saved in the 1980s to the 2006-2007 crisis, 75% of that wealth is now gone. And for these households, their home equity is still the most, prominent part of their portfolio as a means to accumulating wealth. And so when you put those kinds of, when you sort of step back and take those two big takeaways for me in context, you've got a sense, and you sort of back them up against the kinds of risks that we still face. For me, there were three sort of key risks that are still with us. One, the way that we've made that the market makes credit decisions has fundamentally shifted in a permanent way. You've got banks and non-banks competing aggressively for that prime consumer, of which there aren't many. And so now the crisis still resonates with them. And so now they're thinking about what kinds of algorithms, which are driven by machine learning, underwriting decisioning models that are driven by machine learning algorithms. Because banks are competing, but they're also very worried that they must get that default risk, that prediction, right. Secondly, the risk of, originate and hold is it's a thing of the past. It's now permanently old school. And so for me, that risk of holding portfolio loans and what that means, I think it sort of sets up a scene where you've got perfect conditions, I think, for moral hazard behavior. And then you add to that what I think we're not really paying attention to is this growing class of fringe consumers who, when you think of the risk that their well-being or inadequate economic well-being poses, it puts all of us at risk, the entire financial system. So in 2016, the CFPB put out a report, and it showed that 26 million individuals in this country are either credit invisible or they have thin files. And what that means is that these 26 million people, I think, rival the number of uninsured Americans in this country. That's a public policy problem. right? And so when you think about, who these people are, disproportionately African Americans, Hispanics dominate or predominate that segment of our society. And yes, on the one side there's social ills, but on the other side there's a market opportunity here. There are, what we've seen in response to this kind of growing share for fringe consumers, as I call them, an explosion of fintechs. They are fast innovating in credit decisioning models, what kinds of proxies to predict default risk, and on top of that, also innovating in digital products, which I think some of them are edge, and they're billed as access to credit, so just expanding access to credit. When we think about where we are in our political environment, our regulatory system is already ill-equipped to deal with this kind of flexible innovation. And on top of that, most of what we do have is pretty much at risk or under attack.
Thank you very much, Makeda. Okay, so now we'll move on to Simon. So Simon, the same question.
This is Ron.
Sorry, Simon. My
okay.
apologies. Yes. So we'll go ahead and move on to Ron then.
Sure. I've always wanted to be Simon, so I appreciate it.
I was going to say the same. Vice versa.
So I appreciate it. So I'm just trying to cover 3 things in the 5 minutes. That, grab it.
Yeah.
Oh, the whole time?
No, yeah.
Hold it. Okay. Is that better? Okay. I'll start over again. So I'll try to cover 3 things real quickly. So one is Neil already sort of at a high level described our plan, and I'll give a little bit more detail. I'll talk a little bit about what this means for community banks. So these are the small banks that are operating in cities like DC and rural areas, not the big banks that we're really worried about. And then Bill asked me, Professor Spriggs asked me to talk a little bit about what this means for the Fed and how we should think about the central bank. So I think Neil, as my boss, did a fantastic job talking about our plan. There's not really much more to say, but the key feature really is that, as Neil said, that we're going to require more equity. Just sort of at 1 million feet, I don't think everybody is thinking about it day in and day out like we are. So there's really 2 ways that banks fund themselves. One way is that you give a bank money, and they're going to agree to give it back to you. That's like a deposit or a bond. So it's basically a promise that they're going to return it. Or you can give money to the bank, and in return you get ownership. And that's what equity is. So they're not promising to give your money back. You're part of the ownership structure of that bank. The current plan, as it stands today, to fix the too big to fail problem, is that there's going to be a special group of people who are going to give their money to the bank. They're going to be promised to get their money back if the bank gets in trouble. But in fact, during a crisis, they're not going to get it back. And by them not getting it back, they're going to bear the loss, and taxpayers like us are not going to be. So I'll just repeat that. There's going to be a special group of people. They're going to be on the hook. And when things go wrong, the money that they were promised to get back, they're not going to get back. That's not going to work. Why is that not going to work? Just think about it. We're in the middle of a crisis, and our solution is going to be, oh, you thought you were going to get your money back? Now's the time we're not going to give your money back. Well, during a crisis, people are going to try to reassure you. Is the way to reassure you by saying, you know that $1,000 you thought you had coming back? You're not getting it back at all. So what's the alternative? The alternative is to have more of the money where you've given the money in, but you never had a promise of getting it back. That's the money that historically in this country and in other countries actually takes losses. So what we're proposing is to increase that significantly. And the idea really is that by having more of that money there, those individuals will take the losses and not taxpayers. I mean, it really is that simple. And as I said, the current plan really requires us to imagine that during a crisis, we're going to take steps that actually make things worse. Oh, I'm not done. That's just my first point, man. So that's the first thing we're going to do. The second part we'll talk about real quick. You might say, well, if the money isn't at the banks, it's going to go someplace else. Well, we are going to basically tax those other financial firms so that they don't have an incentive to take on that risk. So that's really our plan at a high level. It's simple. It's straightforward. It's true it does occupy this book, but if you think this book is big, you ought to see what the current plan is. If I added up all the regulations and rules, you would have a stack this big, and the bottom line is it's too complicated to work. It's been shown to not work in prior crises, and the plan that we have is the kind of plan that will work. So that's the first thing. The second thing is, what does this mean for small institutions? And President Kashkari was asked in particular about minority-owned institutions. Our plan is good for those institutions. first, we're going to make the big banks smaller, basically, by making it harder for them to grow. That's going to give room in the markets for small banks to get more market share. And the second thing is, there's a lot of rules and regulations on small banks that basically has arisen because of what the big banks did. Well, if you deal with the big banks, you're finally freeing up some space to help the small banks. And I don't mean get rid of all the rules for small banks. I just mean make them tailored for the small banks so they're not facing sort of burdens that large banks are facing. So this is a plan that I think is going to help small banks. And then the final thing I'll conclude with is, what does this mean for the Federal Reserve? And I get it, I work for the Federal Reserve, I worked for the Federal Reserve for 20 years, this is a question that I think is important, but it's actually important to all of you. Now, why is that? Because when there are central banks that are not subject to a lot of political pressure, they tend to do a better job of keeping inflation under control. The Federal Reserve right now is in a really bad position because if there is another financial crisis, the expectation is that we're going to do something about it. Even though some of the rules and powers we have been taken away to do something, during a crisis, people are going to look to the Federal Reserve to do something. So what are they going to look us to do? They're going to look to us to try to create, to try to lessen the blow that the financial system is having. But those are exactly the steps that have people not supporting what we're doing right now. If you look at public support for the Federal Reserve System, it was never lower than it was after the financial crisis. People thought that we did what we needed to do, but it feels really, really unfair for us to be doing something to help what looks like we're helping out financial institutions and not helping Main Street. So if we are going to find ourselves in a position where we have to do something again, it's going to be deeply unpopular, and as a result, there's at least some probability, I should say I'm speaking for myself here, not for anyone in the Federal Reserve System, there's a greater chance that reforms will be undertaken that remove our independence. So what do we need to avoid that? Well, what we need is something that makes it less likely we're going to have a financial crisis in the first place. What's the thing that makes it less likely to have a financial crisis? Make these banks have more equity. If they have more equity, then the equity holders take the losses and we don't have to step in. So it's for even on a very narrow way of thinking about it, it's better for the Federal Reserve System if we have a plan that protects us in the first place from having to get involved. And now I'm done.
Sorry about that. Thank you very much. Appreciate it, Ron. Okay, now we're going to go ahead and move on to Heather. The same question, do you need me to repeat it, or are you fine?
I'm good, thank you. Thank you, Dr. Spriggs, for inviting me, and to all of the organizers and to all the folks who are here today. So to just give a moment of background for folks, I see a lot of young faces in the room that may not know, the AFL-CIO is the American Federation of Labor and Congress of Industrial Organizations. We are organized labor in the United States. We represent 12.5 million working people. And working people, union members, have around $7 trillion invested in the financial markets in the form of pension plans, 401k plans, and other health and benefit plans. And it's my job to interact with the pension trustees and try to engage on behalf of those union members and try to convince companies to behave more responsibly, and also to push for strong financial regulations to prevent us from having to lose trillions of dollars yet again in a financial crisis. So the AFL-CIO has for decades actually worked on financial regulatory issues, engaging mostly with the Department of Labor and the U.S. Securities and Exchange Commission to try to push for regulations that will make our markets work better for our pension funds. Unfortunately, what we saw in 2008 was that we had to look beyond that, because what happened was, Makeda did a great job of talking about the disparate impact, really, of the financial crisis on minority families. Families across the board lost around 28.5% of their wealth. 401ks and IRAs lost $2.4 trillion in the final 2 quarters of 2008 alone. And the pension funds, public pension funds, still have not recovered from the hit that we took during the financial crisis. In 2007, the typical pension plan had around 92% to 98% funding. These are public funds. In 2016, the year for which the data is most readily available, the typical funding was just 68 to 72%. So the markets have been going up, as we've heard time and again. Wall Street is recovered and making, has gone way surpassed where they were in 2007, 2008. But the regular working families have not caught up. So the AFL-CIO saw that it was imperative for us to start working on trying to promote financial regulation across the board, to try to look at how we address systemic risks in the system, and we're really engaged on trying to push for Dodd-Frank. But one of the things that we discovered as we started to look more deeply into what was happening in the financial sector and that work that we were doing on financial regulation was that there was something that was happening in our economy that has come to be known as financialization. And that was really undermining productivity growth and growth in the real economy more generally. And what I mean when I say financialization and talking about the banking sector is that for many years, banks were focused on lending to businesses that were growing and creating jobs. And this was key to creating economic growth. And it was important for us as labor unions because we want good jobs for our members. When Glass-Steagall was rolled back, traditional commercial banks started putting a lot more of their resources into essentially gambling in the financial markets, and we're using that gambling to try to drive returns instead of investing in loans to productive businesses. I see lots of economists in the room who probably have lots of technical terms to describe this, but this was something that was really worrisome for us at the AFL-CIO, and so we have become big supporters of policies that we believe will force traditional lending businesses, banks, to move back into focusing on the real economy. And so we support policies like Glass-Steagall, reinstituting Glass-Steagall, but we also support policies that we believe will mitigate the chances of future financial crises, like the policy that President Kashkari was talking about before, and other policies that have been introduced that are intended to really rein in excessive risk in the banking sector, and mitigate that financialization that we think is harming the real economy more generally.
Thank you very much, Heather. Really appreciate that. So we'll go ahead and move on to Simon.
Okay, thank you very much. So Neil gave a great speech earlier in which he said we avoided a Great Depression after 2008. And I've been thinking about that since he spoke and listening to my fellow panelists. I'm not sure we did avoid a Great Depression. Yes, we avoided it for the financial sector. We avoided it for relatively wealthy, relatively high-income people, but I think Makeda laid out the facts to you very clearly, that people at the lower end of the income distribution with less wealth to start with, including many members of minority groups, they went down and didn't come back. And we should look at this, Makeda. I think it could be that the loss of wealth and the persistent effects of that on household formation, on education, on health, it would not surprise me if the effects on, let's say, the lower 50% or 30% of the income distribution in the United States, I would guess that was roughly similar to what we saw in the 1930s. 10 years, prolonged loss of opportunity, depressed wages, very similar experience. And I should say that I agree completely with Neil and Ron and the work they've done, and it's a great privilege to be on a panel with people, Heather and Makeda included, who've worked so long and hard to move American policy in a better direction, to avoid having another Great Depression of this particular kind. But frankly, I have to say, I think we're going in completely the wrong direction with regard to current policies. So let me take three dimensions. One is on too big to fail. We have a really sensible, articulate idea expressed here by Neil and Ron and their colleagues. It's not getting traction. It's not going to be implemented. The board of governors of the Federal Reserve, which Neil made clear he's not implicated, is moving the other way. They're actually step by step in ways that are perhaps not completely obvious to you or many observers. They're weakening capital requirements. They're making it easier for the big banks to get bigger, easier for them to take on big risk, easier for them to generate the kind of systemic problems we had before. So too big to fail, still with us, getting worse, heading in the wrong direction. If you don't believe me, stay for Senator Elizabeth Warren, who'll be with you shortly. Secondly, on consumer protection, and this is one of Makeda's main points, that we should not separate this discussion. Consumer Financial Protection Bureau, which actually was originated with an idea from Senator Warren before she was a senator, really fundamental, important attempt by the Obama administration, by Congress, to change the playing field, to level it out, to make sure that finance genuinely created opportunities for everyone, not just opportunities for some people and lots of hidden risks for other people. And thank you, Makeda, for your work at the CFPB. Incredibly important institution that is now, frankly, being gutted because it has fallen into the hands of the people who believe that consumers do not need effective protection. That is, I'm afraid, the core of another set of catastrophes, both at the individual level and household level, and the kinds of problems that will accumulate and once again lead us into great macroeconomic difficulties. The third point is one that is still perhaps a little bit more to be decided, but Makeda also flagged this for you, and this is the impact of the latest technologies in finance, including artificial intelligence. So the bottom line is, if you look carefully at how these technologies are constructed, and we do quite a lot of work on this at MIT, there are plenty of people who work on the engineering side, I work on the business economics side, the opportunity is that you could see things about people and recognize potential, recognize an ability to pay back a loan that maybe is not captured in traditional credit scoring, and that perhaps could create opportunity. The risk, though, is if you train your algorithms on the data of what is, then many times you are actually reinforcing the kinds of biases that were already long established in credit practices. Now, how do we use the FinTech to create opportunity, including for young people, in a way that is fair and reasonable? And perhaps there's some risks. There are always some risks around finance in any dimension. We also got that from Neil's talk. But the risks should be clear, they should be understood, they should be manageable, they should be commensurate with what you can afford to lose, for example. How do we get that and a more fair credit system and a better funding of opportunities, business opportunities, personal opportunities, education opportunities? How do we get that without being taken advantage of, without falling prey to unscrupulous operators? Yeah, FinTech is not yet big enough to become catastrophic for the whole economy. But I have to say, and you really should, as I say, I tell all my audiences in the world, if you're only going to read one book about the financial crisis, you should read my book, 13 Bankers. But if you're going to read 2 books now, if you're going to read 2 books, or if you just want to cut to the chase, read Ron's book with Gary Stern, written in the early 2000s. They wrote about these problems in a completely prescient way. The economics of their analysis is exactly what we're talking about today. Before those problems were at the scale where they could bring down the economy. Between 2003 and 2007, 2008, it scaled up a lot and became this devastating shock. So we should be confronting all of these issues, including on consumer protection and FinTech, at the same time as we try to rein in too big to fail. And now is the time to have this discussion and to press for policy changes.
Thank you very much, Simon. So these were just the foundations for our overall discussion. We'll try to bring those in. For now, let's go ahead and start with a lead-in question based off of some feedback that we received from the panelists. So I was going to go ahead and start with Makeda. Definitely everyone feel free to jump in as you feel comfortable. So could you explain the threat of large banks as predators amongst communities of color and the risks to consumers because of financial concentration? What financial policies are still needed to protect communities of color?
So I think I alluded to some of this before. What emerged out of the crisis, aside from the wealth, structural wealth and income inequality, is this huge growing class of fringe consumers. What I mean by fringe consumers is that they are on the edge of the traditional mainstream financial service sector. So it means they're pretty much locked out of credit cards. They are, and sort of, and I think what they do is they represent this huge market opportunity. As economists, I don't think it's the government's business to get involved and tell business or industry what products to create, but there's a market opportunity here. Up against, and so that sort of creates these, I think, the ripest conditions for FinTech to proliferate. FinTechs are these financial technology firms that if you open your mailbox, you can see, oh, would you like a startup student loan or a small business account, a small business loan, even if you don't have a small business, because something in the machine learning algorithm sort of told you that you might proxy be a small business owner. And so when you think about thin file applicants and minorities of taking up a large space, there isn't a lot of information in the system. So I'm talking about the bias that Simon raised before. And what you end up seeing is we're moving in a direction where risk is becoming more and more opaque. and less visible. And so if institutions aren't able to predict that reliably, but they're still, innovating in that way, and our regulatory system is always lagging behind, far behind. And on top of that, you've got Director Mulvaney and others really hammering and gutting the most, proactive or most innovative elements of our financial system, our regulatory system. And so when you sort of put all that together, you're really attacking consumers' financial resilience. And I think that's really important. If you're not resilient, you don't have an immune system, you cannot respond, much less recover from a crisis or a shock. We are in a place today that communities of color, in my mind, have very little immunity to withstand or absorb any adverse macro shocks. And so what that really says is, go back to the Prosperity Now study, that 72% can blossom very quickly overnight to 80 and 90%. Now let's talk about artificial intelligence. That artificial intelligence and all its representation is shifting the labor market in a very structural way. So we're doing these two things all at the same time. And yes, some jobs will be disrupted, but history has taught us the most vulnerable populations, the ones that are least trained, the ones that can least afford, tend to clump or tend to cluster in the disruptive part of that. So when you put that two together, minority communities are distinctly at risk for the future, not just financial consumer protections, but access to credit and also the labor market. So I think we really need to kind of take a step back, and the Federal Reserve should take leadership here. This is not just about too big to fail. I think too big to fail will always exist, and whilst we grapple with how to contain them or make them smaller, we should use whatever regulations are in the system. We've got plenty to sort of incentivize banks to either self-correct or to self-right size, whatever that looks like. And I think there are opportunities, for example, with the Community Reinvestment Act of 1997. There's a lot of ways we can tinker and incentivize banks to, one, invest and rehabilitate these communities. So let me give you an example. Bank of America has been, I think, consistent, correct me if I'm wrong, a consistent member of the systemically important financial institution list. In 2011, when they took over countrywide, they paid about a $335 million settlement arising out of steering. And this is steering prime-eligible minority customers into subprime products, 200,000. They paid $335 million. And that sounds huge, but I want to bring it to the consumer side. If you divide that number by 200,000, that's $1,675 on average for each check. For each check that each person received. So there were two outcomes. Some of those families were still able to, continue to make these payments. $1,675 does not even begin to compensate those kinds of borrowers for the high cost interest payments they had to make. Think about, most of them ended up defaulting. And so what happened is that they've now been forced to, they're now almost permanently locked out of the middle class. That's one. Two, they've been forced to move back to renting in poor quality neighborhoods. On top of that, others are now going back to being sequestered into economic and racially segregated neighborhoods. Raj Chetty and others have told us, have provided irrefutable evidence that their children will endure long-lasting economic consequences. $1,675 does not begin to kind of compensate for that sort of harm. Dodd-Frank did not go far enough. It doesn't even give the CFPB recourse to go back and begin to collect the kind of restitution. I think Dodd-Frank, there are different ways that we can extend this conversation. I agree, Dodd-Frank didn't go far enough and we have more to go. But we got started in the right direction. And I'm not sure how we convince the political powers that be that we need to not be deregulating, but we should be, fixing what didn't work well, keep the parts that work well and sort of change and fix the others. We're at a crossroads, and I'm really worried.
Can I jump in, actually?
Yes, please.
So I agree with everything Makeda said. What we're talking about when we talk about financial markets regulation is how we protect people from being preyed upon after they earn money. I think it's important when we're talking about a broad policy landscape to also to think about how we make sure that people are able to earn a living wage. And the policies about full employment that President Kashgari raised are obviously important, and monetary policy is critical in that regard. The other thing is we've got to give working people the ability to bargain with their employers so that they can raise their living standards.
I was also going to ask, so Ron, since you're on the policy side, are there any discussions on the table for how to protect people in this era of big data analytics in terms of making sure that are able to receive a loan, and there's no bias in that area, especially when it comes to communities of color, which have been susceptible to predatory lending practices and other types of.
Yeah, I think the issue is less are there policies and laws on the books already to do it, and more about the enforcement that we're going to have. And so I'm not so sure that it's an issue of quote unquote big data, because the people who are enforcing these rules, in theory, have always had access to all the data that the firms have, and so so maybe that IT systems are better, maybe we can look at the data in a different way. But the ability to look at the data has always been there, and the responsibility to do it has always been there. So it comes down to how committed are the different agencies to doing that. And I do think that was one of the rationales for setting up the CFPB in the first place, was that if you had an agency whose sole mission was to look at that, then it wouldn't be one of 16 things they were supposed to be doing.
Yeah, Ron, I think the specific concern and issue is that if we're talking about artificial intelligence and machine learning, a lot of those algorithms are black boxes. So that even the people who write the programs can't tell you exactly how the program is. Whereas previous traditional programs are potentially more transparent. And so I think it leads to this question of, what are the ethics of using this? Who has what kind of scrutiny? What's our expectations as a society? Good news is it's still a relatively new issue and it's in front of us. Bad news is we already see some biases coming through very clearly, including, for example, one of my colleagues at MIT has demonstrated vividly and to the absolute, I have to say, horror and embarrassment of the industry, that facial recognition software is highly biased and doesn't work as well across different skin colors. It's absolutely completely clear, and the companies are trying to fix that. So more of this kind of exposure and understanding, where does this lead us, is going to be super important.
Can I just add to that?
Definitely.
I think we don't need to, I don't want us to get too far ahead of ourselves with artificial intelligence and what it is, and it is scary, I admit. What I think that we should also sort of focus on is what's in front of us that we can tinker with and control today. So I keep mentioning the CRA, so the Community Reinvestment Act, frighteningly or embarrassingly, I think was a conduit for a lot of the harms that took place in communities of color. So the CRA, you get a rating, and you get this rating by passing a three-part test: lending, how's institutional lending, your investment, as well as your service test, which really is about having a physical presence and taking deposits and sort of providing retail services in the community. Now, CRA disproportionately just focuses on area. Is it a census tract? Does it qualify as LMI? And that's it. Examiners aren't necessarily looking at the quality of loans that underlie, that placement. And so what you could find is a lender could presumably, be packaging or actively dealing in predatory subprime products in an LMI area and still get credit and still pass the test for serving the credit needs of a local minority community. How ridiculous. I mean, how unsavory that we are, on the one hand, fighting, here, out in the field in our different workspaces, fighting aggressively to sort of put protections in place, and on the other hand, we've got a regulatory system that is giving credit, for example, to a Bank of America, and then they turn around and they do $200,000. So I think there are ways, there's flexibility, and let me just kind of, CRA, I think, is extremely flexible, weirdly so, because it really kind of gets at the incentivizing banks to behave better. Dodd-Frank is wonderful, CFPB supervision and enforcement powers are wonderful, but they take place after the fact. And the scope isn't far enough, it isn't deep enough, and it doesn't generate the kinds of restitution that's required to ameliorate or amend the harms. I think we should look at places that we can be more progressive in terms of incentivizing the right kinds of behavior. I think we should tie CRA noncompliance closer to the federal safety net. So now Goldman Sachs and Morgan Stanley can go to the discount window. What does their fair lending performance look like? I mean, what does Bank of America's CRA rating look like? And if you sort of bring those two together, then maybe they should pay a premium at the discount window, or maybe they should be made to maybe they get a bump if they invest in like really great investment product, community development products, for example, and get more weight in their CRA tests as opposed to just what we have right now.
Okay. Since we have a lot of students in the room, I think we still should maybe lay a little bit more of a foundation. So I'm going to go ahead and direct this one to Simon. So could you briefly explain to students, how did banks become too big to fail? How did this happen? Just a small.
All right, it's a good question, and the important historical fact is that we didn't, in the United States, always have banks that were large relative to GDP, large relative to the economy. Actually, there was a long-standing political tradition, supported by almost everyone, that banks should be kept relatively small because we were worried about concentrated power. That was the main rationale. From the 1970s and 1980s, there was a broad push towards deregulation. I think in some industries it played out, better. But in the financial sector, it led to consolidation. It led to a lot of banks buying each other, buying other banks, and becoming bigger. And by the end of the 1990s, you had the situation Neil was talking about, where 6 to 8 banks had become very large, and they got very heavily into mortgage-backed securities, and that was the mechanism of further expansion. At the time Roland's book was written, 2003, 2004, that was just beginning to hit. It scaled up massively subsequently. That greatly expanded their balance sheet. So, in 1990, there were no trillion-dollar banks. By the time of the crisis, we had several banks that were 2.5 trillion. For a while, we thought Wells Fargo might represent, it was smaller, it was about 1.5 trillion. We thought it might represent, about what you could run in a reasonable fashion. Now we discover it was full of fraud and abuse and predatory practices. So I think that the concerns are these large banks were created by market mechanisms. The people who run the banks made good compensation for themselves. They got some billions of dollars in bonuses during the early 2000s, but the losses that they imposed on the economy and the crisis that Neil and his colleagues were confronted with in 2008 was on the order of magnitude of trillions of dollars of potential losses and lost GDP. And even though we had an escape relative to some other potential outcomes there, the mechanisms that were used for that escape did not prevent the enormous trillion-scale losses for the lower end of America. So that is a very, very sad history, which unfortunately we're in real danger of repeating.
Would anyone like to add to that, or? Okay, so I'll go ahead and direct this question to Simon. So could you explain the inherent risks that large financial institutions and financial concentration has on the macro performance? So basically,
Sorry.
Ron.
That's fine.
oh, I'm so sorry.
No, it's okay. We all look alike.
No, you don't. It's just,
So
my list is.
they're still paying attention. That was good. You can't tell students sometimes. Maybe the thing I'll focus on quickly is at the heart of the issue. So what's the problem here? Why can't we just get a bunch of elected officials and policymakers together and say, something, we know it's a bad thing about these banks, we're not going to do it. And the real problem is, to use like this sort of technical term, it's not credible. So you say it now, but in the future it's not going to happen, right? And that's the essence of the problem here. The problem is that you think you have a plan in place because it sounds like it's going to work today, and then in the future, when you're actually confronted with the problem, you don't do it. So let me give an example. The classic example is giving a test, right? Why do you have tests in college? You want students to study. You want students to learn, and the threat of the test is really what gets people sort of to practice and review. That's the idea. So really, what ought to happen is a teacher ought to tell you, 2 weeks from now we're going to have a test. I want everyone to get ready. Everyone gets ready. You show up in the classroom, and they don't give the test. What's the point of giving the test? The point of the reason why they had the test in the first place was to get you to study. If you knew that was the case, the next time they said we're going to have a test, no one would study, because when you actually showed up for it, it wasn't there. So it's not credible to sort of pull it away at the end. In the same way, it's not credible now to say we're not going to bail out these banks. So I just want to remind the one point I made here. The current plan for solving this problem is that if we have a big financial crisis and you're watching you're on your phone, you're looking at Twitter about maybe this bank's in trouble, maybe this bank's in trouble, maybe the financial markets are going to collapse, maybe I'm going to lose my house. The plan is right now, at exactly that time, I'm going to tell 5 of you in this room, you just lost a ton of money. That's our plan. We're going to tell some of these people who own these bonds from banks, we're not going to pay you back even though you thought you were going to pay back. Your reaction is going to be not, oh good, things are all good now, I don't have anything to worry about. Your reaction is going to be, oh my God, they lost their money, I might lose my money, I'm going to go take my money and take it out of the bank. I'm worried about it. What's that going to do? It's going to make the crisis worse. So the thing you always need to think about is, what's our plan today that when we're in the middle of the crisis, it's actually going to work. It's actually credible. And the only group of people in the United States and in Italy and in Egypt and in other places, if you look around the world, the only people who ever really take losses when a bank fails, and sometimes they don't in some of these countries, but at least in the United States, the only people who ever lose money are the stockholders. Those are the only people who are ever going to lose money. The bondholders are not going to lose money. So the plan we have today that we're counting on, we have no basis in the United States for thinking it's going to work. But that's what we're relying on. That's why we wrote this book in 2004, because the plan we had there was, I won't even get into it, but it was even less credible than the current plan, and it didn't work. Now we've got another plan that's based on something that's not going to work, and I think all of you in this room should think about the fact that if we don't get a plan that's going to work, we're going to repeat back exactly the situation that we found ourselves in, and the losses are going to be enormous. So we really need to get ahead of it now.
So you've been calling me Ron, so I'm channeling my inner Ron. No, it's okay. Here's a point from, and Ron's connecting with the audience, and here's a point from Ron's book that you need to think about. So let me take the 5 students in the second row. Sorry, Bill, I'm going to skip you on this. They've all been paying very close attention. So we're going to give you tickets to go to Las Vegas. Actually, we could just send you to that casino just off the Beltway here, but Vegas sounds better. You go to Las Vegas, and we'll tell you, the good news is, if you make any losses, we'll bail you out, right? We'll protect you on the downside. Now, you go to Vegas, are you going to bet more or less when you go to Vegas? Like, how much more? Yeah, as much as you can, right? Because you get to keep the other thing is you get to keep the upside. The upside is yours, the downside Ron and I will take care of, or the American taxpayer, right? What a great deal. So you're going to take more risk, and are you going to be more careful or less careful with that risk? Yeah, why? I mean, look, you made a lot of money, let's bet it all on red, right? Who cares? Because the downside is not your problem. That's the incentives of too big to fail at its heart. That's what Ron's book is all about. And that, at the level of 5 students, it's not going to damage the macroeconomy. But if you're the 5 biggest banks, or the CEOs of those banks, and you can get a massive bonus for 1 year, 2 years, 5 years, by taking a lot of risk, and then when it all goes wrong, because, you were riding your luck a bit too long, it's not your problem. And actually, by the way, all the people who made the big money in the early 2000s, who were they? They were the CEO of AIG, Bear Stearns, Lehman Brothers, Citigroup, and the other big banks that came really close to collapsing, right? And they walked away with every single penny. So, good deal.
Can I say one thing real quick? I just want to build on some of the comments that have been made. So, if our plan is so great, why is no one supporting it? I think it's a reason no one asked that, but that's a reasonable question. So what you're going to hear is, well, if you make these banks have to have more equity, they won't make loans, and that's really costly. I really want to reiterate the discussion that Michaela had about how costly it is when there's a financial crisis. Sure, let's say a bank, not everyone agrees, but let's say they have to, instead of charging $1 for a loan, they're going to charge $1.10. I don't want to minimize that, but you have to weigh that against the losses that are being suffered, the disruption to the economy, really the 10 years that we've been having to live with the outcome from what was a Great Depression for some individuals. So you have to compare those two. That number is so enormous that if we can get ahead of a financial crisis, it's going to pay for itself.
So that's the substantive answer, right, for why we haven't done it. Unfortunately, I think that the reality is that there's a huge political reason that people are not taking this policy seriously, and that has to do with the exorbitant amount of money that the financial sector spends lobbying and making political donations here in Washington. And so we see it every time we go in. I've been doing this for 11 years now. Every time we go in and try to lobby for a policy that to every person in this room and every person out on the street and every person out in middle America seems like the obvious solution, they are so much more difficult to get the elected representatives buy-in on because of all of the money that the financial sector is putting into our political system and really undermining democracy and the policies that would protect us.
Can I just add to that point there?
Please.
And I think people need to, you guys need to realize how lobbying even takes place, right? It really tries to leverage or take advantage of influence. So I worked on the Hill for about, a short while. And the nicest parties that I went to, the people who were most gracious to explain these really complicated rules, were the lobby groups, not the NGOs or the non-government organizations, the nonprofits who really protected, like AFL-CIO, that protected workers, protected, consumers, protected households. Their briefings were, chock full of statistics and like truthful explanations that honestly the staffers don't connect with, or the legislative, our Congress and House of Representatives don't understand. Think about the Facebook hearings. It was really difficult for me to sort of sit through and listen to Mark Zuckerberg talk about, a really critical issue that's facing our time: data privacy. Who gets access? How do we participate in that process? Because I gave up my access for you to market to me on an individual basis, is I give you the right to sort of take it and use it in these nefarious ways. Our legislative directors, our people who set our laws, don't even understand that basic technology, and you guys are already ahead of us. Facebook is for us dinosaurs, like Snapchat and Instagram and the other manifestations of technology. But that is a real part of the obstacles and challenges that we face in trying to match policy, which you think is sort of reasonable policy, with, I think, the crazy votes, the crazy outcomes. Influence is really, really critical. And what are the incentives in the system? And I think it's smart if we sort of begin to, on our side, sort of set up strategies or tactics to attack and maximize or take advantage of those own influences for ourselves to get the kinds of outcomes that we're interested in.
Thank you. Okay, so the next question I have is for Heather. You just briefly discussed financialization in your opening statements. So could you also explain how financialization is impacting the generation of middle-income jobs or middle-income households?
Sure. So we see financialization not just in the banking sector, but across the economy more broadly. What's happening is we see businesses, for example, businesses that we were talking about earlier that you would think of as making cars or refrigerators or consumer products or providing a service, that are, instead of putting their money into research and development, are playing around in the financial markets or trying to put money into buying back their stock off the stock market to drive up their stock prices, or putting a bunch of resources into figuring out how to do creative games with their taxes to try to drive up their share price. This drives up their executive compensation, drives up returns for shareholders. Unfortunately, it does nothing for the regular economy. And so what we're seeing is what we would call the real economy, the economy of people who are producing goods and services, is being starved at the expense of this financial economy that's making a bunch of rich people a whole lot richer and leaving the rest of us in the dust.
Thank you. Thank you very much. Now to Simon. Sorry, my seating list is a little different than what's on the stage. This is the confusion is coming from. My apologies. What are some of the reforms that the current administration is planning to introduce that could have an impact on the health of the financial system? I know it's a policy-related question, but I'm trying to get away from the political sort of nuances of it.
Okay, well, look, this administration, I think, has got a multifaceted, broad approach to roll back every single dimension of regulation. So how much time do you have? I would start, the one that's easiest to see is the Consumer Financial Protection Bureau, because the CFPB is, I think, relatively obvious to people. It's about making transactions more transparent. It's about having full disclosure. It's about no deception. The CFPB was pushing, for example, for much better, clearer rules for payday lenders, people who lend to lower income people who have trouble getting from paycheck to paycheck. And I think that's all been rolled back. In fact, my understanding is that people running the CFPB previously accepted when they were in Congress significant contributions from the payday lending industry. Kind of an interesting fact if true. I think that's the top of my list. The measures taken by the board of the Fed are also of grave concern, because I think they're bit by bit and in perhaps a fashion that's a little more opaque or harder for the ordinary bystander to understand, they are effectively changing the terms of the deal. So more upside risk for the people running those large banks, more of the downside, implicit insurance provided by the rest of us. There are other moves afoot. The Office of the Comptroller of the Currency, which is sounds like a wonderfully arcane Civil War kind of job title, and it is. Latest reports are they're also pursuing various ways to make the bank's life easier and to back away from any of the kinds of sensible restrictions that were adopted after the previous crisis.
Would you like to add anything to that, Ron? Okay. So my next question is actually going to be directed towards Ron. Could you explain to our students, some of them have taken my class, some have not, basically this idea of quantitative easing, and how has quantitative easing affected the Fed's independence?
Right. So, so what the Fed normally does is to change monetary policy is we try to lower or increase the short-term interest rate that banks are charging each other, and we think that'll change the interest rates through the economy. But during the crisis, when interest rates got to zero, we could have tried to think about making the interest rate negative, but instead what we did was thought about purchasing bonds. So there was no real credit risk. We bought treasuries or bonds issued by other parts that were effectively of the government. And so the issue that people had, the concern people had, is because we were doing something different, our balance sheet, since we were buying these bonds, got bigger and bigger, and to many individuals it looked like we were doing something. I mean, I'm trying to simplify here. It had the same effect. We were trying to basically change interest rates to make it easier for people to borrow. But I think a lot of outside observers saw our balance sheet getting bigger and bigger, and to them it looked like we were engaging in activity that just seemed different from what we did before, and maybe in a way sort of growing our power, and maybe there was concern about the kinds of bonds we were buying. So the bottom line is we're now in the process of letting those bonds roll off, and at some point our balance sheet will be smaller. And so I think certainly it's raised a lot of concerns from some outside individuals. I will say one of the concerns people expressed at the time was that because we were engaged in this, there'd be runaway inflation. So some of these concerns didn't really come to pass. But nonetheless, I think we're committed to trying to, where we can, use the normal interest rate tool to figure out how to affect monetary policy.
I'd just like to throw one thing. I mean, I think the Fed did what they could, as did Neil and his colleagues, to avert worse consequences. I think, and Makeda also laid out, an interesting agenda that would include the Community Reinvestment Act as ways you could use existing tools to help people who have not had a good deal from the existing financial system. But I think we need to think more broadly. I don't think we should limit ourselves only to these existing tools. I think the Federal Reserve has a limited mandate for a reason. And I'm not opposed to Makeda's ideas at all, but I think we should also think about other measures, other policies that can be adopted, that can be promoted to generate middle-class jobs, for example, to have more growth in more communities of those middle-class jobs. We used to be really good at that in the 50s and 60s. Not that everybody did well, but we created a lot of those jobs. And since the 70s, we have really backed away from it. It's not a national priority. It's not the center of our conversation. We don't think about, okay, what would it really take? What kind of jobs do we get? And now the robots are coming. They really are coming for those middle-class jobs. Maybe everyone will end up still employed, but the evidence in the past is that a lot of middle-class people got pushed down to lower income, lower skill jobs, less opportunity, with all the effects on families and communities that you know very well. So I think we need to think as broadly as we can, including at this moment. There's another presidential election coming. I would hope this will be a much more central debate and discussion for that presidential election. What exactly is on the table for middle-class jobs around the country?
Okay, thank you. So this next one's from Makeda. I know we've spent a lot of time discussing sort of AI, machine learning, and algorithms of the sort, but you touched upon predatory lending a bit in your opening statement. So are the financial policies of today sufficient to prevent predatory lending in the future, or widespread predatory lending? You don't have to.
It's funny. I can say I think we started doing that under the Dodd-Frank Act, given its limitations. But I really question whether We are on a sustainable path to continue to do that work and improve upon it. Because of the sustained attacks that the Bureau is currently under. Well, Director Mulvaney is just on a rampage, I think, right? Not just to gut the Bureau or gut, certain aspects. I think he just wants to sort of skirt the law and put the Bureau into a comatose state. Now, there was a 2009 GAO report that sort of took this really comprehensive look at our regulatory system, our financial regulatory system. And some key findings sort of came out of that report. This is 2009, prior to Dodd-Frank. And there were some pretty damning findings that said, the OCC, HUD, FDIC, the Federal Reserve Board, these all agencies have always been tasked with fair lending oversight responsibilities and making sure that markets were operating, providing credit. They all failed to some degree because there's sort of like, some agencies are well staffed, others interpret the law a little differently, so they go at it a little differently. In some agencies, there's political will to enforce and to enforce the law and to really protect consumers. In others, that will was lacking. And so I think for the first time in our history, and one of the other sort of findings or statements in that report was that, and Neil, you talked about it, over 150 years, we've developed a regulatory system in response to crisis. We have to change that around. And I think Dodd-Frank was our first chance, imperfect as it is, to actually change that legacy or to sort of think about what are the risks of the future. This is not just about minority communities, this is about middle-class America, right? What's going on? What risks does artificial intelligence pose to all of us? And how do we get in front of this? What are the updates to our legal and regulatory framework? And I stick, Simon, to this very narrow thinking today on maybe we can fix what we already have, because it's so politically challenging to have our leadership think differently. I'm surprised that we attack Dodd-Frank, they attack Dodd-Frank this much, but CRA remains unscathed and untouched. And that's why I think there's promise there. But if we continue on this route, I think it's not just about that 26 million, invisibles and thin fat people that I talked about. They're not all African Americans and Hispanics. Here's the other thing: a lot of our biases keep us thinking that minorities are only African American and Hispanics. Native Americans have a distinct kind of suffering in our economy that is long-lasting and continues to endure. Because of their spatial segregation, they remain out of our public view. We don't talk about them. We don't imagine them and their experience as minorities. And that in itself, is problematic. Not to mention, all Asians do not, have the same rosy picture as we have been led to think. Different groups have different experiences. In fact, the Vietnamese, for example, I think in the crisis, have a similar experience to African Americans and Hispanics when it comes to discrimination, pricing discrimination, origination discrimination. We're at a really critical place in our society, and we have to really sort of stand up together. I think Heather and I were having a conversation earlier, and she said Comey's statement around, we don't need Trump to be impeached. No, we all need a front row, slow walk through the process, through the pain of not participating in our civic our society, or sort of not advocating for the kinds of rules and regulations that protect all of us and our children to come.
Heather, would you like to add anything to that? I know you also have some interest in these topics as well.
I think Makeda did a terrific job, actually.
Okay. All right, so I will direct this next question to you, Heather. How has the traditional role of banks changed over time as you see it?
I think Simon did a great job of talking about, and Neil talking about how banks have evolved and gotten bigger. We talked a little bit about financialization earlier and the shift from traditional banking, which was lending and taking deposits, into riskier areas. One of the things that Dodd-Frank included was the Volcker Rule, which was intended to stop banks from doing some of the riskiest activity, which was owning hedge funds and private equity funds, and essentially acting like hedge funds, what people refer to as proprietary trading. But there remains a lot of really risky activity that exists in the banking sector that would be addressed by something like the 21st Century Glass-Steagall Act and some of the other policies that have been discussed to try to bring banks more down to size in comparison to the size of the economy more broadly.
Thank you. So I know Neil also touched on this and Ron did too, but could you one more time, or perhaps go into more detail, what are the pros and cons of imposing losses on bank bondholders in addressing future crises? Ron?
For me?
Yes.
Well, I think the con is that it won't happen.
Okay.
Not really sure what the pro is. I mean, if that's something that would actually happen, I think it would be a great idea. But we could sort of sit around. And let me just say, I think people who are pursuing this are well-intentioned, and I'm sure they imagine it's going to work. Maybe to give one example. So during the financial crisis, I think people have heard of Fannie Mae and Freddie Mac. So these were organizations that were set up. Before the financial crisis, those firms were required to sell a special kind of debt that was meant to take losses if they got in trouble. Those firms got in trouble, and the people who owned that debt did not take losses. This new plan that people have thought about, it's not just in the United States, it's also in Europe. So in Europe, particularly in Italy, there's been a bunch of banks that have gotten into trouble. The chance to impose losses on these bondholders was present, and in 3 of the 4 cases, they didn't suffer losses. I don't want to make it sound like I'm in favor of running around and imposing losses on people who own these bonds. Like, it's not like we get some pleasure from that. But if your plan is that we're not going to have taxpayers pay because these bondholders are going to pay, if the bondholders don't pay, then the taxpayers pay. So there's no free lunch here. Someone has to pay for the losses. And if we don't want it to be taxpayers, it has to be somebody else. And if it's going to be someone else, we think it's the people who are the owners of the banks. Those are the people that are the equity holders.
We did exactly a version of this in September 2008. Neil and his colleagues at the Treasury and the Fed thought very hard about the Lehman Brothers situation, and it was decided after many twists and turns that the only feasible option was for Lehman to go bankrupt. So Lehman did go bankrupt, and the bondholders did face losses. 24 hours later, the consequence of those losses spreading through the financial system and the implications for the prices of many other financial instruments, debt and things related to debt, that were so catastrophic that, again, Treasury and the Fed decided that AIG had to be saved, as a bailout, that money market funds had to be come under the protective blanket of the Federal Reserve and through the FDIC, and all of these other large banks, the Goldman Sachs, Morgan Stanley, Citigroup, Merrill Lynch, Bank of America, that they were all now too big to fail. That phrase, too big to fail, while it was anticipated in the 80s, and Ron Gary's book reflects the first time I think the term was used and became widely used was after the failure and implications of Continental Illinois in the mid-80s. But the real modern consequences of too big to fail that we've been grappling with today come from what happened in September 2008 when the officials, with the best intentions in the world, tried to impose losses on people who had risked by lending, but they found that the consequence of that was so devastating that they took another path with the bailouts, and that path, which was better than the available alternatives, has still turned out to be catastrophic for millions of Americans. So let's not go there. That's why I'm supporting Ron and Neil in their current proposal.
Great, thank you. Really appreciate that, Simon. So I'll direct this next one at you, Makeda. How has the role of black-owned banks changed in light of rising bank consolidation?
I'm sorry.
So how has the role of black-owned banks changed in light of rising bank consolidation?
I'm going to have to defer to one of my colleagues on the panel. I'm not really sure. I think that black-owned banks tend to be on the smaller side. Right. But I feel like there's a fallacy that black-owned banks can't cause harm to their own communities as other banks, whether regional or too big to fail or some other size. I think, we sort of need to sort of take sometimes color out of our conversations and think systematically around what kinds of, let me step back. I think what's missing is having banks that access the federal safety net, whether it's the discount window, whether it is federally insured deposits, that they need to be accountable for their consumer and societal impacts. That fundamental link is missing, which is why I sort of advocate for policies that you go to the discount window and you're not compliant with CRA. I mean, Wells Fargo look at that scandal. I look back at their CRA metrics, ratings before I came here. All of them were satisfactory, outstanding. So none of that risk showed up in their CRA rating, which is why I go back to the lending test. If you are trading in predatory lending and in vulnerable communities, one, our system should not be automatically rewarding you on one hand and giving you with another. You should pay a penalty. And so maybe those funds, I think, Simon, your point earlier was like we need to think broader. The one bright spot I'm going to give this administration is the opportunity zones legislation that somehow found its way into the tax bill. I think that is a place where we could innovate broader than housing, and it would be the first, I think, sort of seed around fostering investments in the community and economic development space outside of a debt framework. And you talked about the cost of debt. We really need equity in minority communities, whether it's coming from Black-owned banks or others, to really begin to revitalize communities in a broad-based way. But to the true question, I'm not equipped to answer.
Well, that's perfectly fine. Perhaps I can ask you one more question more in your wheelhouse. How has bank consolidation impacted the role of small banks in expanding equitable access to credit? This is for anyone in the panel who's open to ask this question. If not, I'll move on. Okay, so I'll ask Makeda one final question. So you mentioned 26 million credit invisible individuals. Could you sort of elaborate on that, and maybe we can spark a discussion in that area?
So credit invisibles are people or thin file are a set of individuals whose credit files are basically have no information in there that's useful or predictive enough of their credit risk. And so, and I think emerging out of the crisis, when you've got a ton of foreclosures and toxic exposure to those predatory products that have this knock-on effect, it really sort of disproportionately connected with the Blacks and Hispanics. So really, for me, I've got a credit file that's maybe 20 years, long, and it's pretty thick. And when I say thick, it has hundreds of variables wide that sort of go into this. You think about regressions, in your economics classes, sort of go in and they all feed into this model that kind of gives me the score, whether it's 720 or 800, and that is predictive of my ability to handle credit, manage it, and pay. And so I look good, and for that, the market rewards me with lower interest rates, or lower pricing on my loans. But there's 26 million people who systemically pay higher rates of interest because of their inability to, because the file doesn't have enough information on them. Not saying that they're high risk, it's just the variables that we've collected just systematically can't predict the kind of risk in the ways that we're normally accustomed to calculating that risk. And so there's, I think, a really vibrant debate going, and hopefully we'll continue this, around what alternative sources of data can, going to your question earlier on big data analytics, can we begin to bring in responsibly into the credit conversation to reasonably and responsibly expand access to credit. There's some, Sophie and some other startups, it's like LendUp and Zest Finance, who I think are headed in the right direction, but they might be playing with some dangerous variables or factors in their credit models, or that their machine learning driven algorithms, that when they interact with each other can produce and reproduce systematic algorithmic bias. And so going back to the questions we've all been grappling with, right? We have to be very vigilant about that, and our regulatory and legal system need to be very strong and agile to really, I think, effectively exercise oversight.
Do we have any examples of this sort of bias occurring with any firm to date? Do we know of any firms that are sort of using bad practices?
I actually have personal experience with this. We talked about a potential partnership with one of these institutions, thinking that it could be an opportunity to bring access to credit to union members. And when we went in to have the conversation, I flew out and sat down with them, and basically what we determined from the conversation was that they were not capable at that point, this was a couple of years ago now, of creating a product that would be available to the typical person that is a member of the AFL-CIO, because at that point, they were focused on, they had different models, so it wasn't a FICO score that they were looking at, but they were looking at people who graduated from Ivy League universities and, had advanced degrees and owned a home and, all of these factors. And it may be that that's where they need to start in order to build their business, and they can begin to move into, people who are lower down in the credit risk profile as they build the business. But in the earlier phase, at least when we were talking to them, they were not prepared to extend credit to people on reasonable terms that were, the typical working class individual. So it was an issue that we ran into. And then the other point that I would raise that is, I think, important for us to think about is that when we're talking about these new spaces that are available to provide credit to individuals, we have to look at access to credit, but we also have to look at the regulatory structure. As with every other financial innovation that exists, what we're seeing now is that the regulators, if there's a gray area in terms of the applicability of their jurisdiction, then oftentimes they don't write the rules and they don't monitor the practices carefully enough, and we end up pushing predatory activity out of the traditional sector and into these new innovative practices, and opening up the opportunity for more predation than, in some instances was existing in the traditional banking system.
So I guess the assumption is the perception of creditworthiness, is that changing over time? Is that the sort of general sentiment?
I don't think it's the perception of creditworthiness. I think it's what factors can we rely on reasonably to predict, right, credit risk. And I think we need to sort of step back from the demand side of the equation and look at the supply side too, because there are implications on that side as well. Now, these algorithms, your shopping attitudes on Facebook, which ads you click on in Instagram, help to decide what kind of marketing you might be susceptible to. And that's valuable information, right? That's sort of like the classic example of our data being monetized and sort of being high value. Now, there are large swaths of communities around in this country that are exposed to a very different kind of mailbox and credit offers than 20036. And that goes back to other services. Amazon. When I first moved to the city, I was sitting one day on H Street waiting for a sandwich. I was like, oh my God, Amazon has restaurants too? This is amazing. And so I looked it up whilst my sandwich was being made. And it turns out their restaurants serve every other zip code except mine, 20019. Well, what makes mine different from 20020? It's a high minority census tract. It's gentrifying, but these thick descriptive data sets can't see that kind of differentiation. And they can't see the economic value that me and the other 200 homeowners are bringing to this neighborhood. And so for that reason, 10,000 on average households are in the zip code are now cut off from a delivery service. I call that redlining. It might be redlining in food delivery. I think there was a recent article that the mayor took up this new VIA, right, the Uber Lyft transportation service on the same issue. So it's not just about the demand side and access to credit. It implicates so many other aspects of our lives in fundamental ways, and we really need to be engaged. And again, going back to what Heather said, our regulatory system has to be flexible enough, innovative enough, and proactive enough to sort of have some level of foresight and then adapt to be able to sort of rein in this kind of risk, sort of put guardrails as Neil mentioned.
You should all do this next time you're sitting around with a bunch of friends. Open up your favorite ride-sharing app, and I don't know if it works for all ride-sharing apps, but it works. This certainly works for a very big one that starts with the letter U. And compare and put in the same destination in everybody's cell phone, and I bet you will get substantially different prices, because they are price discriminating in a very sophisticated way based on who you are and certainly what you've done with them. Whether they're using information about other parts of your life, I don't know, but certainly your ride history. And they're basically thinking, okay, how much does Simon want to go from here to there? What are his likely alternatives if we offer him this price? And if you want to get a better price, by the way, I'm giving you the full package of advice here, open that app, look at some prices, and close it repeatedly, like every day. And you'll be sending a signal to them that you didn't like the price yesterday, you didn't like the price today, and eventually they'll offer you a better price. So we have to learn to navigate in the world of artificial intelligence,
I do it on
machine
Facebook.
learning.
I go on, I'm like, I want to see what the new designer's on, and I click, and I close, and I come back, and then after a while, I'll start seeing, the kinds of designs I'm looking for, sure enough. So I manipulate that kind of data. There's no reason why you can't too.
So I'll go ahead and try to bring Ron to this discussion. So are the policymakers looking at these type of issues, to these new types of lending institutions, lending clubs, SoFi, these types of banking systems, and how this is basically shaking up the lending market?
I thought you were going to ask me, are policymakers comparing Uber the way they decided? I'm not sure that that's sophisticated. Yeah, no, I think, the area I know the best is the Federal Reserve. I'm really not speaking of that, but yeah, we're monitoring it really closely for the whole range of issues that were brought up here. I think people have captured it. There's a lot of upside, there's a lot of thought that there's going to be a lot of benefits, and the question is that going to be realized or not? And I think it's just too early to tell. I wish there was a longer answer, but I think that's where it stands today.
So during the Obama administration, the Department of Treasury put out a request for input from people who were in the FinTech space, and they actually issued a report in 2013, if folks are interested, that talks about the different platforms that are out there and the different ideas that people have about what should happen in the regulatory space. And there was actually a report, an additional report from the GAO that came out just a few weeks ago that I have not had the chance to read yet, but it's another. So I think that the regulators are starting to look and starting to think about what they should be doing in this space, but I'm very skeptical that in this current environment where the trend is to try to slash and burn everything that is helpful to consumers and regular people, that we're going to see, positive movement in this direction. Hopefully they won't totally destroy the CFPB in the next few years, and the new administration that comes in will start to look more closely in this area.
Okay, thank you. I think we should open up to some questions to the students. So those of you guys have questions, we have 2 podiums here. We welcome all questions to our panelists.
Sure. I think the way to think about it, we expressed it in terms of the interest rates going up, but maybe the way to think about it would be some people who got a loan before would not get a loan before because at different prices, higher prices, there can be fewer people that are going to be that are going to actually get the loan. And I think the way that at least we're thinking about it is it a big deal or not a big deal? It's a big deal or not a big deal compared to the benefits of having higher capital. And what we show in this sort of very thick report is if you use relatively the same data that the Fed and other people use, and you use basically the same sort of methods that they use, you can show that the benefits of having higher equity for big banks, it swamps this issue about the little less lending occurring. So it seems like it's a pretty good deal. And I should say, since this report came out, there's been a lot of other work in academic journals and different policy institutions that are sort of across the board, and they're not related to our work at all. And uniformly, more and more of that work is saying that the level of equity that we're saying should be in banks is the right amount. And so I would say if you just looked at the facts of it and where it's going, this would be a good policy, and it's sort of being reinforced by the work that's come out more recently.
Could we just, though, agree not to use this verb hold capital? It's the wrong verb and very confusing, including people studying economics. It implies I'm holding a bottle of water, right? It's an action. This is not about what's on the asset side of the bank's balance sheet. It's all about the liability side. It's how they fund themselves.
Sure.
So please say, And by the way, it's nothing to do with you. This is the Wall Street Journal gets this wrong every day. Some ex-Wall Street Journal people. So we should say fund themselves with more equity relative to the debt. It's a funding question.
Correct. Yes. If I said hold, I meant fund.
No, he said hold. You said hold, and you didn't shoot him down.
I said hold then. I have a second question. This is also for Heather, because she brought up the fact that the financial sector is becoming more prominent part of the American economy. And I know that before the financial crash of 2008, financial sector, like corporate profits as a percentage of like corporate profits in general, was like almost 40%. So I was wondering if the panel thought that this was a bigger, like meant that there would be more volatility in the American economy just because more of the, I guess, total value of the economy is in this financial sector, which is more risky, and is more dependent on like the bets that few people take in their conventions. So I was wondering if you thought that we should be worried about the fact that the financial sector is so big.
So I definitely think we should be worried about the fact that the financial sector is so big. I think of it more in terms of the role that finance is playing relative to the rest of the economy, which is another way of saying, I think, what you were saying. And my concern is not so much that the size in and of itself is a problem, but that we need to be financing the real economy so that businesses are investing in ways that create products and services that people in the U.S. and overseas want to buy. So that creates good jobs for regular people. In terms of, the volatility question, I would defer to the economists on the panel who think more about volatility and see if you guys have thoughts on that.
Yeah, those profits were illusory. They were booked profits, but they represented a view on what the implicit losses were going to be on those loans that turned out to be completely wrong. So anytime the answer to the question is that you should see that as an perhaps unexpected but important danger sign. When the financial sector generates very large profits, abnormally large profits, it is typically because they're taking abnormally large risks. And I would notice that most people in the second row have already gone to Vegas since I made them that offer. So it's just further indication of people understand, people follow the money.
Hi, Colin again, freshman economics major. I'm wondering, one of the biggest factors that helped lead to the financial crisis is the fact that people who should really not have been getting certain mortgages because their FICO scores were trashed, basically were getting those mortgages, and then those mortgages were shipped off to different packages. So how do you resolve the tension between that fear and extending credit to people who normally would not be able to get that credit, either because they've been discriminated against or that some event in their life caused them to have low financial standing?
So thank you for that, and I bet there are other people on the panel who want to weigh in on this. I think I would start by changing a little bit the way that you phrased the question, because when I think about the issue, it wasn't so much that people were getting access to credit that they should not have been granted. It was that they were being given access to credit on terms that were unaffordable. And so the issue was not so much that they didn't deserve the loan. It was the issue was that the lender was including terms like balloon payments or interest rates that shot up after a couple of years that they could not repay. And oftentimes the lenders were making promises to them like, if you look at what's happening in the real estate market, you'll be able to refinance in 3 years. Don't worry about it. You're never going to actually have to pay this elevated interest rate. And so I think there's a story that's been told because it's convenient for a lot of people in our economy that there were all of these borrowers out who were taking advantage of the system, and they should never have gotten loans. And that's probably true for a very small number of people. But the reality is that the systemic problem was that there were all of these mortgages that were being made on terms that were just ridiculous. And what we're seeing in one of the requirements that was put in place in Dodd-Frank was that lenders would have to look at the ability to repay, the borrower's ability to repay the loan at the time that they're making the loan. And one of the things that's really scary is to watch as there are, policies that are being pushed in Congress. And I haven't seen anything at the CFPB just yet, but maybe it's coming, that are designed to roll back that requirement that lenders consider the ability to repay. That's problematic for not just the individuals that are making those loans, but as we saw in 2008, for the entire economy.
Yeah. I mean, I think you're right. And let me just go back to your question. There is truth to your statement that there are some people who should not have gotten those loans. If you're making $400 a month, then there's no reason you should have gotten a $400,000 mortgage. But what the crisis really exploited was information asymmetry on the part of consumers. And that is really one of the critical value adds of Dodd-Frank. So think about, when I had my first mortgage, the 1003, which is our loan application uniform, loan application is so small, it's so dense, and a lot of the fees were hidden. So one of the big problems, and so Dodd-Frank came and dealt with it, was yield spread premium. And let me tell you how that worked. I can come and qualify for a prime loan. This is not about subprime. Prime loan, and the broker who I'm interfacing with has the full authority and discretion to mark up or just add a spread on top of what the bank approved on its rate sheet. And that cost did not show up in the truth in lending finance charges, and largely was hidden from borrowers. So you think about how much, not just the life of the mortgage, how the mortgage is structured, but even the upfront costs, right? So FHA is one of those programs that provides access to credit, but it has a huge upfront obstacle that minority borrowers or sort of cash-strapped borrowers can't cross that hurdle and access home ownership. But just sort of, going back to Heather's comments, really kind of debunking these myths around, personal responsibility. There's some real structural issues that, going back to Dodd-Frank, looking at where the law decided to sort of focus on and actually implement real structural fixes, that's pretty much what you should be focusing on as a sort of takeaway from this conversation.
Thank you very much, students. Sorry, unfortunately, we don't have any more time for any more questions, but we definitely appreciate all your questions. Thank you, panel. Thank you, Makeda, Ron, Heather, Simon. We really appreciate it. So we're just waiting on Senator Warren to come. So hope you guys are all enjoying the event so far. Thank you all my students who came. Those of you guys are in my class, make sure you sign the sign-in sheet with Telvin in the back so you get credit for being here, extra credit. It's a very good discussion we've been having thus far. So we'll be commencing very soon. Let's give Dr. Warren some time to set up, come in. Have you guys enjoyed this so far? Pretty good? I think we'll have to wait till the end. I'm not sure if we'll have time. Based on the schedule, I don't think that we will. But at least we'll get to see her. On the bright side. I'm not big into actors, but I'm big into politicians, so this is exciting. Yeah. So did you guys learn a lot about banks being too big to fail? Yeah. Now you guys know what it is? Yeah. Oh, hello. Oh, you can just come that way. Yeah, come on up, please. Hello. Welcome.
Welcome. Thank you. It's good to be here.
Oh, it's our pleasure to have you.
It's nice to see you. Thank you. Thank you. You bet. Okay, where would you like to, Jasmine?
You can sit on whatever side.
Right over here?
Okay, so I'm going to go ahead and introduce someone who really doesn't require an introduction, but I will do so either way. Senator Elizabeth Warren is a senior United States Senator from Massachusetts. Senator Warren was a law professor for more than 30 years, including nearly 20 years as a Leo Gottlieb Professor of Law at Harvard University. It's Harvard Law School, my apologies. Senator Warren is a persistent and well-respected consumer advocate, and she's widely credited for the creation of the Consumer Financial Protection Bureau, or how it's commonly known as the CFPB. It's our pleasure to have you.
Great. Thank you very much. Thank you. Thanks for having me. Thank you. It's really good to be here. I am glad to be back on a college campus. I miss being on college campuses. But you get the best kind of teaching that I get to do. It means I don't call on you as we go through this. And in fact, I think Jasmine is the one who'll put me through my paces later, and we're going to do some questions. But I'm very glad to have a chance to be here today. Thank you for the introduction. I appreciate it, Gerald. It's good to be here because it's important what we're talking about today, and that is the financial crisis and what it looks like 10 years later. It was 10 years ago this month, in March of 2008, that Bear Stearns fell and kicked off the worst recession since the Great Depression. Within a year, American workers' retirement accounts had lost $2.7 trillion. Think about that. Almost a third of their value. Within 2 years, 8.8 million Americans lost their jobs. Within 3 years, more than 4 million homes had been lost to foreclosures, and millions more were in danger. The financial crisis wiped out as much as $14 trillion in household wealth. But here's the point I want to underline. The losses were not evenly distributed. Before the crisis, big financial institutions specifically targeted communities of color with mortgages that were full of tricks and traps, stripping wealth from families and from their communities. And when the financial crisis came, those same communities of color got hit a second time, with some neighborhoods nearly destroyed by the concentration of foreclosures. On average, net worth of white families fell by 31% as a result of the crisis, while black families lost 40% of their wealth. Black Americans also saw larger declines in their retirement savings than white Americans. The financial crisis and the devastation that came with it was not inevitable. It was not caused by gravity or by some force of nature. It was brought on by Wall Street and enabled by Washington. The story of the 2008 crash goes back to the 1980s. After nearly 50 years in which regulators had kept a tight watch on Wall Street banks and on financial institutions in particular, and nearly 50 years without a financial crash, basically since the Great Depression, America turned in a different direction. Deregulation became the watchword of the day, or to put it more bluntly, fire the cops. Not the cops on Main Street, the cops on Wall Street. The bank regulators looked the other way as big financial institutions over time found more ways to trick and trap their customers. First through credit cards, then through mortgages, home equity lines of credit, and a raft of new financial products. The SEC, quite frankly, was just outgunned. Regulators were clueless as banks developed creative new trading strategies that took advantage of the old rules. Credit rating agencies signed off on the safety of pools of mortgages that were more like boxes full of grenades with the pins already pulled out. And the wall between high-risk trading and boring banking, those two different kinds of banking, was knocked down. And the Glass-Steagall Act was eventually repealed. Washington turned a blind eye as risks were packaged and repackaged, magnified, and then sold to unsuspecting pension funds, municipal governments, and many others who actually thought the markets were honest. And not long after the cops were taken off the beat and the big banks were turned loose, the worst crash since the 1930s hit the American economy. So for me, the moral of this story is simple. Without basic government regulation, financial markets don't work. And that's worth repeating. Without some basic rules and accountability, financial markets don't work. People get ripped off, risk-taking explodes, and the markets blow up. And that's just a fact. So now it's been 10 years since the last crash. And where are we? The bottom line is that we have made progress, but not nearly enough. And we are at risk for going backwards. Now that the economy is beginning to look good, the lobbyists are again flooding Congress and telling politicians it's perfectly safe to roll back the rules on big banks. And once again, it's working. In the early 1980s, lobbyists convinced Congress to deregulate savings and loans. And over the next decade, taxpayers spent $132 billion to bail out those institutions. In 1999, Glass-Steagall, the Depression-era law that created the wall between boring banking and high-risk trading, was put on the chopping block. 90 senators voted to knock down the law. And soon, Congress rolled back other financial rules. And then came the crash of 2008, brought to you by too big to fail banks and the financial shenanigans that were legalized by deregulation a decade earlier. And so now, here we are again. Just last month, literally on the 10-year anniversary of Bear Stearns failing, the Senate passed a bill that would roll back key protections put in place by the Dodd-Frank Act, regulations that had been passed in the wake of the financial crisis. I just want to point out what this bill does that just passed the Senate. It takes banks that are between $50 billion and $250 billion in assets. That's 25 of the 40 largest banks in the country. It takes them off the government watch list, giving Trump regulators the license to give them the kind of light touch supervision, just as if they were tiny little community banks. It allows some of the biggest Wall Street banks, the Citigroups and JP Morgans of the world, to potentially hold less capital and sue the Federal Reserve to get weaker rules. And it rolls back consumer protections on mortgage lending, including exempting 85% of banks from reporting data about who they are lending to and at what rates, which deprives regulators of the data they need to go after discrimination. So, if I can, I just want to spend a minute focusing on that last provision because it has gotten the least attention of all the pieces of this banking bill. I want to talk about what it means, rolling back data collection requirements that help uncover discrimination. There is a long and shameful history in this country of discrimination against African Americans when they try to buy homes. From 1934 to 1968, the Federal Housing Administration led the charge. In a largely segregated America, FHA actively discriminated against black families by refusing to insure mortgages for qualified borrowers in communities of color, while helping white families finance their plans to achieve the American dream. This policy wasn't a secret. Nope. It wasn't the product of a handful of racist government officials. Nope. It was the official policy of the United States government until 1968. That's in my lifetime. And because the federal government had set the standard, private lenders enthusiastically followed Washington's lead. Homes are the way that millions of working families build some economic security, pay down a mortgage, and own an asset that over time is likely to appreciate. A home serves as security to fund other ventures, to start a small business, or maybe to borrow money to send a youngster to college. And if grandma and grandpa can hang on to the home and get it paid off, they can pass along an asset that boosts the economic security of the next generation and the generation after that. But systematically, over many decades, government policies encouraged mortgage companies to lend only to white borrowers. And those policies cut the legs out from under black families that were trying to build some family wealth. The result is exactly what you would predict. It contributed to a staggering wealth gap between white communities and communities of color. And that gap is alive and kicking today. Here's one statistic from Massachusetts. This is according to a study in the Boston Globe. The median net worth of white families in Boston is $247,000. For a black family, median net worth is $8. Think about that. That's something that all Americans, regardless of race, should be ashamed of. You know, when I was traveling around the country in the aftermath of the financial crisis, it became clear to me that the crash had made this problem worse. Subprime lenders who peddled mortgages full of tricks and traps had specifically targeted minority borrowers. And that meant that during the Great Recession, a huge number of minority borrowers lost their homes. And when rising home prices helped white Americans regain some financial security, communities of color, with their lower home ownership rates and their higher foreclosure rates, were simply left behind. And again, I'm just going to give you one example on this. According to Pew, between 2010 and 2013, think about this, crashes happened in 8. So between 2010 and 2013, the median wealth of white households grew by 2.4%. But the wealth of Hispanic households fell by 14.3%, and the wealth of African American households fell by 33.7%. In other words, after the crash, while white families began to recover, black and Latino families fell further behind. Lending discrimination is still rampant today in 2018. According to a new report that just came out from the Center for Investigative Reporting and Reveal, in 2015 and 2016, nearly 2/3 of mortgage lenders denied loans for people of color at higher rates than for white people. The problem affects both big lenders and small lenders, and it is nationwide. In 61 different cities across the country, minority borrowers were more likely to be denied a mortgage than white borrowers with the same income. How do we know that? Well, we know that because of data that federal law requires banks to report. That's how we can see how much black families were charged for a mortgage or how often Latino families were denied a chance to take out a mortgage. And we can compare those numbers with white borrowers who have the same incomes and the same credit scores. But of course, we can't do that if the data are missing. And that's exactly what the data that will be cut out if the Senate banking bill becomes the law. I want you all to think about what that means. Without that data, it will be much harder to stamp out mortgage discrimination. Now, while the Senate and the House are moving to roll back financial rules across the board, I actually have a different idea. Instead of gutting rules while the banks are making record profits, let's make the rules tougher so that we don't end up with another financial crisis and another taxpayer bailout. Millions of American families were crushed by the financial crisis after Wall Street gambled with their money, but nobody went to jail. And sure, regulators went after the banks with fines, but executives just passed those fines along to the shareholders. Then the executives got big bonuses and usually were able to keep their own jobs. And let's face it, this bad behavior didn't stop with the financial crisis. Just take a look at Wells Fargo. So last month, I introduced a bill called Ending Too Big to Jail. The bill would make sure that if financial institutions break the law and scam their customers, the CEOs are held accountable. I have this crazy idea that if CEOs break the law, they ought to go to jail just like anyone else. Now, my bill does three major things. It creates a law enforcement unit that's completely focused on investigating crimes at financial institutions. Think of it as a vice squad for Wall Street. Second, it requires senior executives at banks with $10 billion or more in assets to certify annually that they have conducted due diligence and found no criminal conduct or civil fraud within the financial institution. In other words, no more hiding in the corner office. And third, it gives courts oversight of deferred prosecution agreements between the Department of Justice and companies that have broken the law, allowing these companies to move forward and the agreements to move forward only if a judge determines that those agreements are in the public interest. In other words, no more secret deals. If CEOs are genuinely concerned that they will be hauled away in handcuffs if they break the law, maybe they will run a much tighter ship. That means less fraud and less risk of another financial crisis. So look, I have other ideas for strengthening the financial system. I think we should reinstate Glass-Steagall so that boring banking is separated from high-risk trading. I think we should enhance oversight of derivatives market and fund our federal agencies so they have more resources to stand up to Wall Street. And if we're going to take another look at our financial rules, these are the kinds of bills Congress should be passing, not more rollbacks that help banks that put everyone else at risk. What I can't understand is why we put the bank's to-do list aside, and what I can't understand is why we can't put the bank's to-do list aside for just a little while and work on the things that will really help the American people. Things like passing DACA, reforming our criminal justice system, or passing sensible gun regulations, getting relief for Puerto Rico and the Virgin Islands, or helping those who are suffering from the opioid crisis, providing support for people drowning in healthcare costs, or finding solutions for working families and addressing the student debt crisis. There is so much that Congress could do. There is so much that Congress needs to do to make our financial system more resilient and to tackle other problems that Washington is ignoring. That is our mission. That should be our mission, to make Washington work again for working families. So thank you all for listening. Thank you for being part of this. And now I'll turn it over to Jasmine and we'll do a little Q&A. Yes. All right.
Hello, everyone. My name is Jasmine Goodwin. I am a senior journalism major, graphic design minor from Columbia, South Carolina, and I am the editor-in-chief of The Hilltop. And on behalf of the student body, I'd like to welcome you to our university, and let's get right into it. So let's go back 10 years. During 2007, 2008, we entered the longest economic recession since World War II. From a college student perspective, hardly any students on this campus were thinking of this or directly affected by the Great Recession, but more so perhaps indirectly through a parent, family member, or family friend. can you tell us why does protecting consumers and community from bank power and financial failures matter today, especially to college students, and where do we now stand?
Okay, so that is a good question. How about if we start it, I want to see if I can start this at kind of the 10,000 foot level. I think the fundamental question is, who does government work for? For me, that's like where everything intersects. Is government there for giant financial institutions? That certainly was the case in the run-up to the financial crisis, that it was a case of whatever rules they wanted, knock out regulations, do whatever these big banks wanted, and the big banks made profits like you wouldn't believe. And what happened? They crashed the economy and then turned around to the taxpayers and said, how about $700 billion for a bailout? We need some help here. It's that kind of attitude that we're here to help the big guys and not really anybody else filters down to everything that touches your lives every day. So watch what's happened over the past several decades. Investment in young people who are trying to get an education just keeps going down. Cost of college keeps going up. The need to get an education keeps going up. The difficulty of just making it into the middle class keeps going up. And yet, how much our government, our democratically elected government, is there to be a partner for young people who are trying to get an education just keeps going down. Pell Grants, as a proportion of what it costs to go to school, down. Student loans, oh man, they'll make sure that you got plenty of money for student loans. Only, let me tell you something that shifted dramatically on student loans. Back in the day when my generation needed a student loan, federal government put money on the table so your loan was subsidized. That is, you were getting a student loan at a rate that nobody else could. Plus, they looked at those loans and said, you know, every time a kid gets out there and gets an education, someone whose parents couldn't afford to write a check for college, that's good for all of us. That's part of our national defense. That's what they called it. My loan was called a National Defense Education Loan, right? NDEA. And they said, as a result, if you go to work in something that's good for the national defense, then we're just going to knock 10% off your loan the first year. And the second year, another 10%. And the third year, another 10%. And I'll just tell you one little part about how they defined what was in the national defense back in those days. If you became a public school teacher, that was in the national defense. So as soon as you signed up to teach school, they knocked 10% off your loan at the end of your first year. Another 10% your second year, except for folks like me. I was a public school teacher, but I taught special needs kids. And our federal government said, you know, that is so important and so much in our national defense. We knocked 15% off your loan. So we're going to help you get rid of those loans. In other words, we're going to charge you less, we're going to help you get rid of them. Where are we today? We live in an America today where the federal government makes a profit off the backs of student loans. They're on target to make billions of dollars in profits off student loans. And where does that money go? They're taking money in from young people whose parents can't afford to write them a check to go to college, and then they're turning around and doing tax breaks for billionaires and giant corporations. So we can do example after example on this, but you have to care about this because all the pieces are tied to each other. When the financial services industry gets to pretty much write whatever rules it wants, it ends up putting out mortgages that blow up people's homes. I mean, not physically, but they move you out on the street all the same. When they get to write whatever rules they want, then they end up with student loan servicers who don't care about you. They just figure out how to cut costs. And that means whatever program they put you in, however much you can't reach anybody on the phone, they don't care, right? It's every piece of this relates to every other piece. For me, this is ultimately about how our financial system works, but at the very same moment, it's about how our democracy works. I don't know, Jasmine, does that cover it?
Yes.
Okay, good.
You are also a champion for the U.S. Consumer Financial Bureau Protection under the Obama administration.
You bet I am.
Yes. Okay. A legislative response to the financial crisis of 2007, 2008, and the Great Recession. It is currently under fire in terms of possible elimination by Mike Mulvaney, the director of the Office of Management and Budget for President Trump. What can people in the community do? What steps can they take to protect the legislation that protects us?
Okay, that's a great question, Jasmine. Let me start with why you should care about something called the Consumer Financial Protection Bureau, CFPB. Here's the reason why it matters so much. We've had a lot of laws in America, actually for a very long time, about interest rates and certain things that had to be disclosed on loans and so on. But the deal was, it doesn't do any good to put a law in the books if there's actually not a cop on the beat to enforce it. So all of the consumer laws around mortgages and credit cards and payday loans and all these different kind of loans were scattered among 7 different federal agencies. And no one of those agencies thought they were the ones really responsible for it. And so when the bad first credit cards, starting in the 1980s, when the credit cards just got worse and worse and worse, when they started sending out these envelopes full of pre-approved, 0 interest rate, and then it turns out back on page 31 of they even call it this, they called it mice type, the little tiny fine print. It turns out, oh, well, there was a fee here and an interest rate increase over there and another little trick over here and another trap over there, so that the effective interest rate often on these credit cards would turn out to be, instead of 0%, well, 15% or 20% or 30% or 45%. They just kept going up and up. And the same then migrated over. This was a part of what started going wrong with mortgages, student loan servicing, all the different parts through financial services. And basically the regulators, they pretty much just sat on their hands. They pretty much just looked the other way. They pretty much just listened to the giant banks that walked in and said, don't worry about this. We got this totally under control. We're on top of this, no problems at all. Right up until the day the economy exploded. And how did this economy end up flying over a cliff? I'll tell you one way to think about it. This economy crashed one lousy mortgage at a time. One family that got cheated at a time, just over and over and over, until finally the whole thing came down. So one of the things that came out of this, I had this idea to build a consumer agency, and the basic idea was to say, pick up those laws that are out there, add in anything else we think is necessary, and then create one agency and give them the responsibility, give them the authority that they need, give them the tools they need, and then hold them responsible for leveling the playing field. So that when you take out a credit card or when you've got a checking account at a bank, you don't get cheated. That's the basic idea behind the Consumer Financial Protection Bureau. It's actually not any fancier than that. And here's the deal. So we go into the fights over will the agency survive. And the banks understand this, even after the crash. The banks didn't give up. They didn't say, we were bad, we're real sorry, awful sorry about how we crashed the economy, and let's figure out some sensible regulations. Nope. The banks spent more than $1 million a day lobbying against the financial regulations that ultimately became the consumer agency and Dodd-Frank. Think about that. We're spending more than $1 million a day for over a year. They stayed after it, right? To try, and what was number one in their crosshairs was to get rid of that consumer agency. The agency that would just help level the playing field. That's all it was designed for. You can sell credit cards, you can do mortgages, you just can't cheat people. You just can't trick people. You just can't trap people when you do it. And there was a lot of back and forth. I was still teaching at this point. And I want to put this part out there. President Barack Obama, he stood up for the agency. There were lots of negotiations that went on, some in open and a lot behind closed doors, where people said, tell you what, we can get this thing through on all the other provisions if we'll just basically throw the consumer agency under the bus. And he was the one in the room who said, no, we're going to keep the consumer agency. We're not going to let people get cheated. So we get the agency passed into law. He signs the paper. I was there when he signed it. He asks me to come to Washington for a year to set up the consumer agency, which I did. And then Rich Cordry becomes the director, who's now actually running for governor out in Ohio. Rich Cordry becomes the director, and here's the deal about why you should care about this agency. So it's like, one more agency. It's been up and running 6 years now. Would that be right? It has forced the biggest financial institutions in this country to return more than $12 billion directly to people they cheated. Think about that. $12 billion. And how many banks looked at that and said, you know, instead of going with that plan that we had that was going to cheat people, maybe we'll just back up and go somewhere else, figure out something else. $12 billion. They've also handled more than 1 million complaints and helped people get relief. If you have a complaint, by the way, I just have to say this, can I do my commercial to the side? If you have a complaint, if you feel like you got cheated out of $10 on a fee, on a bank fee that you shouldn't have been charged, if you feel like you put down money on a down payment on a home and they now won't return your $11,000, whatever it is, you can file a complaint with CFPB. You just do it online. Go to cfpb.gov. You can file it online. The thing gets basically stamped that the CFPB knows about it. They send it over to the lender that you've got a problem with. A clock starts running, and the lender tries to resolve this thing, and they are resolving it in a very large fraction of the cases. So it doesn't work all the time, but you're moving in the right direction. You've got somebody on your side, and that's the bottom line. Somebody on your side. So now, banks have hated this thing from the beginning. Consumer agency never got a long breathing spell when it was much loved. The banks and their friends on the Republican side of the aisle started hammering on this agency from the day after Dodd-Frank passed, on and on and on. In fact, one of the lobbyists, you'll love this, one of the bank lobbyists on the day that President Obama signed the financial regulations into law, one of them said, "It's not over. This is just halftime." And then went from there to start on the attack after the agency, after the other financial regulations. So now, President Trump has put Mick Mulvaney in charge of the agency. He's someone who has voted against the very existence of the agency multiple times, wants to get rid of it, is doing everything he can to hollow it out. But here's what I want to say. Yeah, this is tough, but we did everything we could when we built that agency to insulate it from politics. This is something that was very important to the president, it was very important to me. And when I say politics, I mean Democrats or Republicans. Everybody who works there, basically, except for the director, who has to be approved by Congress, is a civil servant. And that means they can't be fired by some politician who comes in. They're there to do their jobs. And frankly, they're protected by civil service to keep doing their jobs. And now, Mick Mulvaney is doing everything he can to knock the legs out from underneath the agency. But I keep thinking about the people who are at the agency. I was there. I hired a bunch of them. Of course, more have come since I left. But these are people who came because they understood why we needed this agency. These are people who understood that you do need a level playing field. Families need a chance. If they're going to build any economic security in a 21st century economy, they've got to have a set of rules that make sure people don't get to skin them. They've got to be able to have a fighting chance to be in the game. And people who came to the agency knew it wasn't going to be easy. They were going to be up against big banks. They were going to be up against some really sleazy financial institutions, and the other side would fight hard. So I look at the folks at the CFPB, they're fighters. That's why they're there. And they fight from the heart for the right reasons. So I know this is a hard time for the agency, but the agency is still out there. It's still doing its job as best it can, and I still put a lot of faith in them.
Howard University is founded on the mission of truth and service, with many of us possessing an entrepreneurial spirit that is then gone on to be utilized to help develop and serve communities. How important is the CFPB and further legislation that would allow for necessary investments to develop these communities and those that are more underrepresented and underserved than others?
Oh, so this is a really good question. Look, capital is what it takes today. People have to have access to money. You want to start a small business, you want to get an education if you weren't born into a family that's rich. It takes access to capital. Whenever you're talking about access to capital, you got to know you're at least on a level playing field. You know, it's hard enough to fight uphill to try to build something, to invest in a future, just because of the risk out there, because it's speculation, because of the amount of hard work it takes. But to do it when you're fighting in a system that's crooked, in a system that's loaded against you, just makes it 10 times harder. So a CFPB to help level the playing field so that more people have a chance. It's the opportunity business. That's how I see this. That's why I think it's critical.
So we're going to, unfortunately, have to cut it short. I want to thank Jasmine so much, our editor-in-chief of the Hilltop, which was co-founded by Zora Neale Hurston. And Jasmine is one who understands that legacy and holds it up. And so we're very proud of her. And
Thank you, Jasmine.
thank you to Senator Warren. This is one of her return trips to Howard. I want to thank Neil for staying the entire time.
I see you down there.
And for opening it up and for leading his staff and helping us to put this together. Again, we have to say thank you to Heather, to the AFL-CIO that provided the microphone so we could live stream this. And thank you to Roland S. Martin, who provided the live stream feed for us. Simon had to leave, but we want to thank the Peterson Institute for International Economics for providing the support so that Simon could be here. Thank you very much for attending, and hopefully you have gotten a gauge on what happened 10 years ago. There are a lot of anniversaries in the African American community this spring. But this one we felt we had to mark because, as you heard from Senator Warren, this was the greatest loss of black wealth since the downturn in the 1920s when we lost thousands of acres of land from a similar type of crash. As Neil pointed out, you know, there are lots of financial crises that take place. That financial crisis started the downturn in black land ownership. So this was a similar size event for black wealth loss. So we had to commemorate, we had to make a note, pause, and think about where are we and what can we do to go forward. Thank you for attending.